सो इंट्रोडक्शन कौन देंगे? चैतन्य देंगे?
Yes,
सर
sir.
मैं वेलकम कर लेता हूँ.
हाँ.
तो I welcome first of all C. Yognesh Desai ji, speaker of the day, C. Asim Trivedi sir, program moderator, coordinator and director also, because the program जो फॉर्म हुआ है वो उसमें असीम सर और फडनिस सर आप दोनों का बड़ा कंट्रीब्यूशन रहा. एंड आई वेलकम ऑल द मेंबर्स ऑन बिहाफ ऑफ इंदौर ब्रांच ऑफ CIRC ऑफ ICI. एंड विदाउट टेकिंग मच टाइम, may I request to Chaitanya ji to kindly give a brief introduction of the Yognesh sir. Over to you, Chaitanya ji.
Yes. बहुत बहुत धन्यवाद कीर्ति भैया. I thanks a lot for giving me the opportunity to introduce dear Yognesh sir to our dear professionals who have joined the webinar today. So I'll start with these lines of Madhushala. अभी कीर्ति भैया ने कुछ याद दिला दिए थे पंक्तियां. मदिरालय जाने को घर से चलता है पीने वाला, किस पथ से जाऊं असमंजस में है वह भोला वाला. अलग अलग पथ बतलाते सब पर मैं यह बतलाता हूँ, राह पकड़ तू एक चला चल पा जाएगा मधुशाला. Yes friends, today we are going to learn the ups and downs.
एक सेकंड चैतन्य भाई, इसका भावार्थ भी फिर हम बात कर लेते हैं 2 मिनट के लिए. जब हम लाइफ में खड़े होते हैं और हमें समझ नहीं आता है, नंबर ऑफ ओपिनियंस डिफरेंट होते हैं, उस समय ये पंक्तियां हमें ये बताती हैं कि हमें कहाँ जाना है. इसको लेकर हमारे माइंड में डाउट होता है. तो हम अगर लाइफ में ये सोचते हैं कि हमें कहाँ जाना है, कैसे जाना है, और हमारे पास डिफरेंट ओपिनियंस है, तो हमें उस समय डिलेमा में नहीं जाना है. किसी भी एक पाथ को पकड़ना है और उसके ऊपर चलते जाना है, तो सक्सेस हमारी होगी. दैट वाज द इंटेंशन बिहाइंड these lines. तो हमारा जो हमारी जो बातें चल रही थी, तो उसका भावार्थ ये निकलेगा.
तो आज जो हम कंसेप्ट्स करने जा रहे हैं, Ind-AS 12 इनकम टैक्सेस, वो भी कुछ ऐसे ही कंसेप्ट्स हैं. तो जिसके पथ दृष्टा जो है आज हमारे सर हैं यज्ञेश जी देसाई, उन्हीं का आज इंट्रोडक्शन देने का जो अपॉर्चुनिटी मिला है मुझे. So I thank TA branch Indore for the same, and I'll just start with वैसे शब्द तो कम ही पढ़ेंगे सर के इंट्रोडक्शन के लिए, फिर भी फॉर्मल इंट्रोडक्शन के लिए बोलना ही है. So as we all know, sir has been sir has been one of the stalwarts of our profession, and he has ample of experience into the Ind-AS and corporate audits and taxation, wide knowledge of all these matters. He is IFRS trainer, mainly certification course of Ind-AS, which is conducted by ICI. He is one of the trainer in those courses. Along with that, he has been trainer in the IFRS courses conducted by ACCA UK. So sir has been at various motivational speeches has been given by sir at various podiums and various platforms across the globe, in fact. So having such a rich and ample experience, I just like to invite Yognesh sir for the today's session, which is on income taxes and which is very conceptual. In fact, a normal human mind cannot understand the concepts of income taxes, Ind-AS applicability, the deferred tax, and mainly the deferred tax what I am talking about. So sir is going to make our understanding in a simple way. He is going to explain today, and we are going to have this feast of knowledge for income taxes Ind-AS in a very um, analytical way. So over to you, sir. Thanks a lot, and welcome, sir, for the presentation.
Thank
Welcome
you,
to the Indore CA branch.
Thank you, Chaitanya, for the wonderful word. At the outset, I am thankful to the chairman, Kirti Bhai, my dear friend Pankaj, and again my very dear friend Asim Trivedi ji. हमारे अच्छे मित्र रहे, and we gel very well. Many times we discuss certain conceptual issues, and he has also guided me in how to use this in webinar certain techniques and all these, which I'm just yet to implement next week. Thank you, Asim bhai, on a personal note. And very good conceived program, very good conceived program. And जब इंदौर की बात आती है तो how can we forget my guru Manoj Fadnis ji. He has been very instrumental in grooming me, I would say, because he has given me a lot of exposure in the Ind-AS training, and that's how I got an opportunity to dwell on the Ind-AS, and उस बहाने में Ind-AS सीखा, उनके जरिए में Ind-AS सीखा, तो उनका भी शुक्रगुजार अदा करता हूँ. So have you given me co-host status? So can I share my PPT? Let me try. Okay, you have already. Okay, you already cleared me. Sir, can you see the can you see the slideshow? Can you see the slides on the screen, sir?
Yes.
Yeah. Can you see this, sir, friends? So I believe last 10 minutes we earmarked for the question answer session. Okay, and at 6:30, I believe another stalwart of the accounting standard and MP VIJAYAKUMAR is going to come, whom I hold in high respect, and perhaps many of the professionals must be holding in high respect. Volcano of knowledge he has. So without doing too much of ado, I start this. And of course, I cannot forget my friend. If agar Abhay Sharma ji hai, to please, hello, namaskar, Abhay ji. If he's there, then my hello to him. Okay, so friends, we'll try today. We'll see today Ind-AS 12, which is income taxes, and but normally when Ind-AS 12 we talk about, people talk about the deferred tax. And this material, the copyright is that I have relied a lot on the ITH bulletins and the educational material, along with naturally the AS12, AS12 and Ind-AS 12. There are two appendix here of this standard. And as far as parallel standards are concerned, there is one standard called Ind-AS. For non-Ind-AS standard, it is AS22. And as far as US GAAP is concerned, you find the parallel topic in the FASB ASC accounting standard code topic 740. Those who want to be little research oriented friends. So, so can we have only two videos on the screen, because otherwise it is disturbing. Me and Asimji or anyone, two video. I don't know whether I can remove it from here or not.
Yeah, I'll remove it.
Okay, thank you, Ji. Thank you. So it deals with the taxes for income tax, and though the title is income tax, we often read this, often mean this as a deferred taxes. And this includes all the domestic and the foreign taxes which are based on the taxable profits. Any tax which is linked or based, the levy of a tax which is based on the income profits is covered by the standards, such as the withholding tax and the even tax payable by subsidiary and associate and all these. I must tell one thing and confess one thing, that we very often IFRS talk about the consolidated financial statements. And even for consolidated financial statements, the deferred tax accounting is to be done. But honestly, that is not done so effectively. What I have seen in practice is that suppose there are one company and 5 subsidiaries. So what they do, they simply add up deferred tax assets and liabilities of various companies, because effectively it is not being done at a group level. only at a group level, if you really want to see how effective it is, but it is in US and in UK where there's a, and that too, if the group files a group income tax return. In US and UK, there is a concept of filing the group income tax returns. So in that case, the parent file the return and the other subsidiaries, they don't need to file the return separately. Then it is very effectively done. Otherwise, this is my experience that when it comes to the deferred tax asset liability, simply people add DTL and DTA as the case be. Am I right, Asim ji? यहाँ
Yes.
पे सही मायने में it is not being followed. It is not being followed in the true sense. What we do, simply add like any other assets and liabilities, we simply keep on adding or subtracting deferred tax asset and liability. That's it. We are not doing so. That's not the real way the DTL is calculated for the consolidated financial statements. Well, this standard does not deal with the grants and the investment credits. That's the okay. Now, this is just an example of my dear friends. Still, there are 2 more videos interacting. So please put them off. The moderator sir, and the technical team, I think Tiwari ji, jara dekh lijiye please. So tonnage tax is not covered. Withholding tax is covered in the IAS 12. In this 12, dividend distribution tax is covered, and the investment tax credits are not covered. It's just for now. Let us look at the definition. But before that, the concept of DTL and DTL is what, sir? Basically, it arises. The concept is because of the fact that a particular item is tax is deducted in my books of accounts to arrive at the account profit. That is, the account profit is a profit or loss for the period before deducting the tax expense. So to arrive at the tax accounting profit, I deduct certain item, or I may add certain item as my, I may treat certain items as an income. But same expense is not allowed, may not be allowed, or the same income may not be treated as an income as per the Income Tax Act in this financial year. So this that income tax will allow the deduction maybe at a later stage, or maybe treat the income at a later stage. So there's a difference in the time, there's a difference in the accounting, in the tax treatment of a particular item of an expense or an income, and this results into temporary difference. Now, there is not a permanent difference. There is no concept of permanent difference. It talks only about a permanent temporary difference. But by definition, it includes only those items which are of a temporary differences. And very nicely, they've put something. Very nicely, they've put something. So if there is a temporary difference, what you do, you take the carrying value, which is as per your books of accounts, and you compare it with the tax base. Tax base is the hypothetical amount which will be deductible or taxable in a future year, in a future periods. So if there is a difference between the tax treatment in terms of time, say for example, I am claiming an expense of a commission in financial year 2020. Financial year 2020-21, I'm claiming certain expenses. But since I have not deducted tax at source and I'm not paying the tax before filing of return, this will be allowed as an expense in the next financial year, okay, 21-22. So this is known as a timing difference. So automatically there is a tax base and the carrying value. So you find the difference between tax base and the carrying value, and the resultant difference is the temporary difference, and multiply with the tax rate. You come to know deferred tax asset or liability. Now, how very brilliantly they put, they have camouflaged the permanent differences. They say that standard says that if an item has no tax consequences, if an item has no tax consequences, meaning if either it is not deductible or taxable at all in future, then it has the same it has the same amount, the tax base is same as the carrying value. So if, for example, the penalty, which is naturally not deductible, and dividend income, of course, now it is going to be taxable, but let us presume that dividend is not in taxable income, or certain kind of income which is not taxable. Say, for example, government grant is not taxable. So they say the tax base and the carrying value is same, as a result of which there is no temporary differences. And naturally, consequently, there is no question of any deferred tax asset or liability. So very brilliantly they put it, the permanent differences in a backstage. And as we know, the taxable profit is a determination according to the taxable profit is determined as per the IT rules. We normally call it computation of income as per the IT. And tax expense is very important thing, which is comprised of the current and the deferred tax. And there lies the real crux of this definition. The tax expense is very important for us, which is comprised of current tax and the deferred tax. Now, current tax is the amount payable as per your what we call computation of income as per the income tax rules. Whatever you need to pay for this financial year is known as a current tax, and whatever taxes are going to be recovered in again the future tax liability are known as the deferred tax. Now, deferred tax could be asset or a liability, and we'll see that basically everywhere you'll find is a temporary difference they talk about. And here we'll see is the difference between the carrying amount of an asset and the liability in the balance sheet and is tax based. Now, tax based is something which you have to hypothetically imagine and create and assume. Friends, you must have seen that when we prepare the statement of income of say a limited company or a public or private limited company, we have two kind of depreciation schedule. One is as per the Companies Act, and second is as per the Income Tax Act. So I would say that whatever the carrying value as per the schedule for the depreciation as per the Income Tax Act is nothing but the tax base, and carrying value we all know that, right? So primarily, this is what you have to presume. Normally, the starting point for this is to pick up the carrying value from your profit and loss account or the balance sheet and compare with the hypothetical tax base or the hypothetical tax balance sheet. But the challenge lies in some cases where the item does not appear in the balance sheet. The item does not appear in the balance sheet because it has been expensed out as per the accounting rules, as per the accounting standards. मिसाल के तौर पे research and development expenses. Now, research stage, all expenses in the research stage are expensed out, and they're not capitalized. Since they are not capitalized, you will not find them in the balance sheet, and hence one has to be very careful because by and large you normally start from the balance sheet and then compare with the tax base and then find the difference and multiply it with the effective tax rate. So care has to be taken to see that you don't miss out this item which is not there in the balance sheet. The reason it has been taxed, it has been claimed as an expense and is not been capitalized. Naturally, it will not be there in the balance sheet. Friends, I am going to discuss something which, as a part of my research analysis, I have studied about many balance sheet of the Ind-AS, and normally people forget this. ये दिल चाहता है कि मैं अभी आपसे शेयर कर दूं, इसका पूरा डिटेल में विवरण आपको बताऊंगा कुछ स्लाइड्स के बाद, but let me make one reference, and this is inextricably connected with the accounting treatment pursuant to Ind-AS 109. You may think that, sir, you are teaching us Ind-AS 12, but why you are dragging us to 109? Because there is a typical accounting treatment as a result of which I have to discuss this. Friends, the Ind-AS 109 says that standard dealing with the financial instruments requires that any directly attributable cost for raising debt is not to be expensed out, but to be deducted from the carrying value of a debt. Now, this is the accounting treatment. So, for example, you spend about 100,000, 1 lakh rupees for raising the debts. Debenture issue करने के लिए आपने 1 लाख खर्च किए. Since the accounting standard requires this not to be spent, not to be expensed out, you have not debited to profit and loss account. But as far as income tax is concerned, you will claim this as an expense because income tax allows this expense. So you have not claimed this as an expense in your books of accounts, correct? So naturally, your profit is going to be higher as compared to the taxable profit. For the same year, when you prepare the computation of income, you show 1 lakh rupees deduction on account of the issue expenses. So naturally, assuming other things being equal, your taxable profit will be less than the book profit. And this leads to deferred tax liabilities. Friends, many companies have failed to account for this because normally we always see we are over eclipsed by the depreciation. जब भी इनकम टैक्स डिफर्ड टैक्स की बात आती है ना, असीम जी बताइए, सब लोग पहले बार करते हैं डेप्रिसिएशन में, राइट सर?
Yes, sir.
सीधी बात करते हैं डेप्रिसिएशन में. There are many other things like convertible debentures, or I would say the compound financial instrument. Even that leads to the deferred tax liability. But somehow I find these entries are missing. So I'm going to draw attention to those entries and we'll discuss about that. Sir, the word taxable, that means it is going to be taxed. You need to pay something in future. There is some liability. So naturally, it leads to the deferred tax liability. And when you say deductible, that means you are going to get deduction against your future taxable income. And naturally, if you're going to say, if you're going to claim some deduction in against the future profits, it is bound to be some kind of a saving in your tax. That means it is a deferred tax asset. So basically both are temporary differences. The one which is taxable is DTL, and the one which is deductible against the future profits is known as the deferred tax asset. All right, now let's see the tax base. Now tax base of an asset and tax base of a liability. The tax base of asset is the amount that will be deductible for purposes against the future economic benefit. That means again, when you prepare your future taxable income statement, you will claim this as an expense in those financial year. Hold your breath. Even if you're not claimed, otherwise this expenses in your books of accounts for those relevant years. For example, let us take an example that certain expenses are deductible on payment basis under the Income Tax Act. But the company since it is following the accrual system, it has claimed these expenses in say year one. Year one, while preparing the books of accounts and arriving at the accounting profit, the company has claimed this as an expense because it is following the accrual system. The same company, when it prepares the financial statements for this year two, in year two, it has received this, it is paid these expenses, like say municipal taxes in the income from house property. So income tax allows these expenses when you actually spend this money. So what has happened in the subsequent financial year, year two, when you are preparing your taxable income, the income tax statement, you will claim this as an expense, even if you have not claimed this as an expense in the year two books of accounts. Okay, so that is going to be deductible for the subsequent year. And a very nice statement they made: if the economic benefits will not be taxable, the tax base of the asset is equal to the carrying amount. So we've seen what is the formula, what is the basic arithmetical formula to arrive at the deferred tax asset and liability. It is the difference between the carrying value and the tax base. So if my tax base is carrying value is 100, tax base is 0, that means it is going to be deductible in next year. The taxable and the temporary difference is 100, and on which I apply the tax rate and arrive at the DTL. But if my tax base and the carrying value are same, the taxable temporary differences will be 0. Resultant, there's no need to calculate or no need to measure the deferred tax asset or liability. Very smartly they put the permanent difference under the guise of this formula. Very simple, बहुत smartly उन्होंने बनाया कि जिस चीज फ्यूचर में टैक्सेबल नहीं होने वाली या डिडक्टेबल नहीं है, उसे परमानेंट डिफरेंसेस उसकी परिभाषा मत दे, बट फॉर्मूला में ऐसे एम्बेड कीजिए कि ऑटोमेटिकली it will result into the 0 temporary difference, and resultant no DTA or DTA will be taken into account. Now, the tax base is determined by reference to the tax return of each entity in the group. So वही कहा कि ग्रुप के सही मायने में डिटेल नहीं होता है, but that's the compromise and we have to live with it. असीम जी और हमारा एक भी रिसर्च का पॉइंट है जो हम बाद में बात करेंगे, बट संक्षिप्त में बता दूं कि as far as Indian income tax is concerned, even I would say the DTA and DTL on the property plant equipment is also not truly followed, because in income tax there is a concept of block of assets. There's a concept of block of assets, whereas in individual statement, as per the accounting standard what you prepare, there's an individual statement, right sir? तो वो खैर हम लोग हमारे वो रिसर्च का विषय है, यहाँ मैं वक्त नहीं गवाऊंगा आपको, but Asim ji, I think we should really work on this. Am I right, sir? Right. Okay. Now here is an example. So basically, I would say in two cases, the tax base and the carrying value will be same. A, when the income and expense are both concurrently and simultaneously are allowed or not allowed in both in the books of accounts and the income tax. Say for example, interest income is accounted on the accrual basis. At the same time, income tax department is also taxing the interest income on accrual basis. That means the tax base and the carrying value of both are same, which will not lead to deferred tax measurement and recognition. This is one case. So when an item of income is being recognized, is taxed simultaneously at the same time in the same year, A, the books of account is treated as an income in the books of accounts and is also taxed as an income in the same financial year, there is no need to go for any rigmarole or any calculation of deferred tax asset or liability. I claim expense as per on the recurring basis, on the accrual basis. Income tax also allows these expenses on the accrual basis. Result, tax base and the carrying value is same. There is no tax temporary differences, and there is no need to measure any deferred tax asset or liability. This is scenario number one. The scenario number two, if an item is let me use the technical word, the tax consequences of an item is zero, then also the tax base will be same as the carrying value. If you refer to this, if those economic benefits will not be taxable, the tax base of an asset is equal to its carrying value. So friends, now our task is simple. So where we need to focus? We need to focus where the taxability as per the Income Tax Act and as per the accounting treatment as per the income treatment as per the books of accounts are different. Income is recognized on the accrual basis in the books of accounts and it is taxed on cash basis. So wahan pe vibhin accounting treatment hai, right? The accounting treatment differs from the books of accounts with that of the income tax. There will be a difference in the tax base and the carrying value. There will be a temporary difference, and as a result of which you need to then calculate the deferred tax asset or liability. Now let us see one thing, and before that I think everyone must be aware of this statement, and I may be a little faster, but let me come to this and we'll go back to the other slides. This is the summary of the entire DTA in detail, and friend, if you learn the first sentence, then all are the derivatives. If the assets carrying amount is more than the tax base, it results into deferred tax liability. My assets carrying will be more than the tax base. That means the hypothetical carrying value as per the Income Tax Act. Now this happens when? This happens under two circumstances. You have revalued the asset up, and naturally income tax has not taken cognizance of that. So when the revaluation is done upward, B, when the rates of depreciation as per the books of accounts are lesser as compared to income tax. Books of account depreciation rate is 10%. So at the end of year one, my carrying value will be say 90,000 rupees on a 1 lakh rupees asset. If the income tax is allowing me depreciation on the accelerated basis, say 20%, my carrying value of that asset will be 80,000. So assets carrying amount is more than tax base. It results into deferred tax liability. Friends, this is not my innovation. This is not my knowledge. मैं तो केवल सूत्रधार के भांति ये प्रस्तुत कर रहा हूँ आपको. It is written in so many public domain and it is there in the standard also. But all that you need to remember is that assets carrying amount is more than tax base, it results invariably, inevitably into deferred tax liability. What is true for an asset is reversed for the liability. So when the liabilities carrying amount is more than the tax base, it results into deferred tax asset and so on and so forth. So in this background, we'll go ahead and now read this. A machine cost 100 rupees, depreciation for the tax till date is 70 till 30, remaining cost. So as per the Income Tax Act, the tax base is 70 and the carrying value is 100, sir. So this is resulting into deferred tax liability. Interest receivable has a carrying amount of rupees 100. The related inter revenue will be taxed on the cash basis. The tax basis of the interest receivable is nil. So I am showing income on the interest on the accrual basis. My entry is interest receivable account debit, category assets, to income, profit and loss account. So my balance sheet has a tax carrying value of 100 rupees, but there is no concurrent value in the tax base. Income tax has not taken cognizance of this interest till such time it is received. So income tax के रडार से ये पर है. Income tax के हिसाब से ये tax base है ही नहीं. It is zero. And naturally, when you apply that the tax base is more than the when the carrying value is more than the tax base, is result into deferred tax liability. Friends, the best way to learn this is do a simulation yourself. Believe me, friends, and then you realize why it is like this, and then don't ratify this. Take one or two hypothetical cases, prepare the balance sheet, profit loss account, and then see whether it actually works or not. But everything lies in one formula. Tax expense is equal to current tax plus deferred tax. Now, this deferred tax could be plus or minus. It could be deferred tax asset or deferred tax liability, and then you realize, sir, how it really works. Now, here I had told you there are two cases broadly in which the tax base and the carrying value are similar, are same. Resultant, there is no temporary difference, and consequently, there is no DTL or DTA. The trade receivables, so that happens when the same treatment is there in the books at the same time in income tax. Income tax, now let us take this example. Interest receivable has a carrying value of a carrying amount of rupees 100. Assume that this interest is also taxable when the interest is accrued. Its tax base would have been 100, and as a result of which there is no need to calculate the deferred tax asset or a liability. So whenever there's a difference in the accounting treatment, you'll see that the tax base and the carrying value has some kind of a difference. These are the steps: determine the book base, determine the tax base, find the taxable temporary differences, identify the exceptions. Now there are some exceptions. We'll see that what these exceptions are. That even if there are there's a difference between the book value, carrying value, and the tax base, उसके बावजूद भी आप deferred tax liability नहीं, deferred tax asset या liability नहीं गिनते, and that will see that if the asset is initially acquired or not. I will come to that little later. Determine the tax rate. Now, tax rate determination also is a big challenge. It's the tax which is effectively effective at the end of the reporting period. If you read this in the conjunction with Ind-AS 10 events after the reporting period, it says that changes in the tax rate is a non-adjusting event. So that means any change in the tax rate which has taken place after the balance sheet date but before the dates of the authorization are not to be considered by an entity. And then consider the recoverability of DTA. Now DTA stands for the deferred tax asset. यहाँ पे in terms of Ind-AS 12 as compared to AS 22, there is a lot of relaxation. In AS 22, the condition for the recognition of the DTA is the virtue certainty. Virtue certainty means I would say 99.999%. One has to be sure that yes, you will have an income in future which will enable an entity to cover the deferred tax assets. Deferred tax assets, there is one more thing that even for some reasons you are not able to recognize the deferred tax assets. Recognize means you're not recognized in the books of accounts, but leave aside the measurement. then you have to make a disclosure about that. That certain DTA is not recognized. That's a different thing. But in future, if there are profits available to offset this DTA, then you can recognize this DTA at a later stage. So an entity has to keep the memoranda of the record and keep it and park this figure somewhere else. Look, this DTA we have not recognized in past because there were huge losses, but now the table is turned. We need to take this into account. We'll come to that later. Then recognize the deferred tax presentation and offsetting and the disclosure. Uh, it is covered later on, but I must tell you the deferred tax are never discounted, whether it is an asset or liability. And they are always presented on the non-current portion of the balance sheet, always non-current. Okay. So these are two important things, and they are offsetable only when it is permissible to do so, legally permissible to do so, and an entity has an intention to do so. Fine. So can you see, sir, here one basic conceptual I wouldn't say the error, but this is how normally people ever start. Even we start. Determine the book base. That means आप पहले देखते कि मेरी बैलेंस शीट में है या नहीं. अगर बैलेंस शीट में कुछ चीज नहीं है तो नेचुरली आप उसे I mean you'll not be inclined to take this into account. And those are the cases where an expense is not otherwise allowed as per the Income Tax Act, like research stage expenses. They may not be fully allowed, but accounting standards say that yes, anything and everything which is spent during the research stage is to be fully deductible. So जाहिर सी बात है दोस्तों, ये आपकी बैलेंस शीट में गायब होंगे नहीं होंगे. इनके लिए आपको मेमोरेंडम डॉक्यूमेंट्स जरूर बनवाने हैं, otherwise you may lose sight of these items. या देखिए इत्तेफाक की बात है कि in the very next slide this is what if certain item has no carrying value. That means they won't be there in your books of accounts. Yes, preliminary expenses, research and development, such situation result into deferred tax asset. Yes, this must have given a result to a deferred tax asset. दोस्तों एक जैसे मैंने बात कही कि a conclusion is that if the carrying value of an asset is more than the tax base, it inevitably results into deferred tax liability. In the same manner, if the book profit is more than the taxable profit, देखिए रट्टा मत मारना sir, please. Yeah, conceptually you may cross-check these two sentences for the validity of your accounting treatment, but don't ratify. At the same time, if the book profit, that is the profit or the accounting profit, is more than the taxable profit, it also results into deferred tax liability. Link ke lijiye, and there are some analysis which is following here. So this is again a summary of it. Temporary differences minus carrying amount is equal to the tax base, and this is also given if the asset is there, carrying amount is higher than the temporary differences, then it is taxable, and then it is results into liability. This is also.
I just want to interrupt here, sir.
Yeah.
The basic problem with this particular accounting standard is that we had accounting standard 22, which was based on P&L approach.
Yeah.
And this particular Ind-AS is based on balance sheet approach.
Yeah.
So the fundamentals and phenomena are the same, just perception of looking the things have been changed.
Okay.
Before we were, as you discussed, that under 35D, if we have preliminary expenses, so preliminary expenses are required to be deferred in 5 years. While in accounting standard 26 or Ind-AS 36, we will say no.
Yeah.
All preliminary expenses should be debited in P&L. So logic, both accounting standard, whether you go in AS 22 or you are going in Ind-AS, they are the same. See.
Agreed. असीम जी बिल्कुल सहमत हूँ आपसे, बिल्कुल सहमत. Yes.
So Ind-AS 112, what this Ind-AS says is that the tax base is different, and this our accounting standard 22 was simple. It said now you are taxing me. Yes. Now you are taxing me. Yes. and you are going to relax me in future. Yeah. So now tax in future I will relax. I will have DTA. If you are now relaxing and then in future you are going to taxing, that would be treated as liability. So fundamentally, it should be kept in mind that if now tax and future relax, it would be DTA. If now relax and future tax, it would be liability. So whether it is accounting standard 22 or it is accounting Ind AS,
Asimji, come again. If now relaxed, huh?
if now relaxed and
That
in
means,
future you are going to be taxed.
that means now relaxed means?
Now relaxed means you have given an additional depreciation
Okay.
in
So now relaxation in the now reduction. Now
now
reduction.
reduction liability, and in
Yeah.
future you are going to increase your liability. So now relaxed and in future tax, that means a DTL.
Detail.
And if now taxed and in future you will get relaxed, that
It's
will
a
be
detail. Detail.
DTA. So in both the cases, it
Yeah.
is the same only.
Asimji,
So
what you said is absolutely correct. Fantastic. This thing conclusion, and that's why I have not gone into the two approaches: like balance sheet liability approach and income tax liability approach. But let me tell you one thing: why in this or the ISAB has introduced the
balance sheet
balance
approach.
sheet liability. एक बात ध्यान रहे सर कि हमारे जो स्टैंडर्ड्स हम कहते हैं एज 22 या एज 15 या एज 3 and all have been borrowed from those erstwhile standards.
Erstwhile standard. Yes.
And those standards where sir ये जो लोग अभी कहते हैं ना कि हमने adopt किया and converts किया, why this hue and cry? Because at one point in time we had already adopted those standards, sir. आप देखिए in fact age 38 in age 38 and age 26 are same verbatim. यहाँ तक कि वहां पे 1 million दिया है, यहाँ पे 10 लाख रुपए का एग्जाम्पल. बट फिर भी बता दो एक बात कि बैलेंस शीट अप्रोच लाने की नौबत क्यों आई. हमारा एज 22 जो है वो भी डिपेंडेंट ऑन द erstwhile IAS 12 till before it was revised. The reason was that in IFRS mostly there is the concept of revaluation and fair value. Now let us take the simple example, and that too a fair valuation of property plant equipment, revaluation of property plant equipment read with Ind-AS 1 or IS 1. Let us take an example. When an entity revalue the asset, correct? The entries debit revaluation, debit property plant equipment and credit revaluation, correct? Now this is again taxed, depreciated at the same revalued amount, and naturally there is going to be some difference in all this, right, sir? But under the Indian accounting standard, under the non-Ind-AS standards, what they do, sir, the additional depreciation which is being charged as a result of the revaluation is plowed back to the profit and loss account. As a result of which, the impact of revaluation on depreciation is nullified.
Yes.
Correct? हाँ, तो वो नहीं था. अब क्या है, sir? Now this plowing is happening. There is an option. An entity may transfer additional depreciation as a result of revaluation to retain earnings when the asset is being used every year, or if that is not opted for, then when the asset is actually sold off or derecognized. So as of today now, so there is going to be some difference. So as per Ind-AS, your depreciation is on the larger amount, which was recapped and nullified under the non-Ind-AS gap. But now under this is. So this is why again some people say that, sir, why it is revaluation karte, it is not impacting, so why it is there. So the point is that this is how, due to the concept of fair valuation, sir, sometimes it may not go through the profit and loss account. Same applies to the fair value of investment through OCI. Correct, sir? Fair value of investment through OCI. Now, fair value of investment through OCI is not traveling through profit and loss account. It was a case with the available for sale investment under the erstwhile IS 39. Correct, sir? So to capture this impact, that it has impacted the carrying value in the books of account, which may sometimes lead to some difference in the book profit and the taxable profit at the end of the day when your asset is being sold off. More so in cases where the revaluation is traveling through OCI and not through profit loss account, they brought the concept of balance sheet liability. So otherwise, when you take the depreciation, कहानी यहाँ से पकड़ो इधर से पकड़ो same आएगा सर. But very good sir, I like this thing. आज हमने बचाया, कल मार दिया, sorry कल टैक्स कर दिया, right? आज रियायत दी, बाद में टैक्स करेंगे, right? Very good, very good.
इंदौर में हम लोग बोलते हैं अभी लूट बाद में छूट या अभी छूट बाद में लूट.
बाद में लूट. बिल्कुल. And the certain facts which I have repeated repeatedly many times, deferred tax assets and liabilities are never discounted and they are always presented as a non-current. Okay sir, यहाँ पे एक थोड़ी सी एक मैंने बताई है कुछ विश्लेषण है that interest income because interest could be expense also is recognized on accrual basis. Now here is the case where the taxable temporary differences it leads to a deferred tax liability. Again, a caveat, don't mug it up. But when the book profit is more than tax profit, and that too due to the elements which is of a temporary nature, it again lead to the deferred tax liability. Calculate this and find out, okay? So the interest income is recognized on the accrual basis for the tax and for the tax purpose, but for the tax purpose, it is tax on the receipt basis. So my income is say 10 crore rupees, which includes 1 lakh of interest, whereas my taxable income would be 99 lakhs rupees. Because when I calculate my computation of income, okay, now let us take how it results into deferred tax liability. चलिए कंप्यूटर जी, let's do this simulation because हमारे असीम द्विवेदी साहब जो दिखाते हैं ना, वो भी एक्सेल का सहारा लेते हैं, वो मैं असीम जी से सिखाऊं. असीम जी, उम्र में मुझसे आप छोटे हैं मगर ज्ञान में आप कुछ क्षेत्र में गुरु है मेरे.
बिल्कुल नहीं सर.
So देखिए यहाँ पे can you see guys the Excel sheet? Computer जी, hello Asim ji, can you see the Excel sheet?
Yes.
Okay, so this is my no, हम रट्टा नहीं मानते सर. This is my books and this is my iTax. Now as I told you, my profit is 1 crore rupees. I would say this is including of the interest. Including interest 1 lakh rupees. So when I calculate my taxable income, I would put it like this: this minus 1 lakh rupees. Okay, sorry. So my profit is 99 lakhs, and let's take the tax rate at 20%. So this into sir, एक बहुत conceptual understanding के बाद 20 lakhs rupees. This is my tax as per my books of accounts, and the same my tax liability is 19 lakh 80,000. सर एक और भी बात बताऊं सिम जी, आप भी शायद सहमत होंगे मुझसे. The very basic counting concept, the basic accounting concept of this standard is what? Is a matching concept. It is a matching concept. हर अकाउंटिंग स्टैंडर्ड में पूछे एक तो प्रूडेंस कुछ कॉन्सेप्ट रहता है, जैसे इम्पेयरमेंट में इज अ प्रूडेंस. सो इन द सेम मैनर इट इज मैचिंग. नाउ लेट अस टेक व्हाट दे से योर टैक्स एक्सपेंस हैज टू बी एज पर योर जो बुक्स जो टैक्स एक्सपेंस जो बुक्स एक्सपेंस एज पर बुक्स ऑफ टैक्स एक्सपेंस एज पर बुक्स ऑफ अकाउंट हैज टू बी एज पर द बुक प्रॉफिट. सो माय बुक प्रॉफिट, माय एंट्री इज लाइक दिस: डेबिट टैक्स एक्सपेंस. So my now देखिए automatically it results into deferred tax liability. And what is my tax payable? Tax payable which I need to pay to income tax department is Simji feel very irritated because उनकी तो एक्सेल की स्पीड बहुत फास्ट है, तो बोलेंगे ये यज्ञेश भाई कितने स्लो है.
नहीं सर.
So this is your okay. Now in my books of accounts, my tax expense has to be exactly as per my book profit, which I've done, sir. So 1 crore into 20% tax expense, 20 lakhs rupees. What I need to pay to income tax department is less is 19 lakh 80,000. Now this leads to a deferred tax liability because this interest is going to be taxed वो हमें मारने वाले हैं जब मुझे वो इंटरेस्ट इनकम मिलेगी. So this is my deferred tax liability is 20,000. And now let's go systematically. My carrying the carrying value of this is interest receivable is 1 lakh rupees. Now, I would say the carrying amount, carrying value, and TB stands for the tax difference, and this is temporary difference because it's going to be taxed at some point in time, and this is my DTL. So now let us take the interest tax base is 1 lakh rupees. My tax base is 0. And always देखिए कि जहाँ पे विसंगतता है means Hindi is not that fluent, but still I'm trying to say विसंगतता है, विसंगतता है means difference in the accounting and the tax treatment. My tax base is 0, and the difference is this minus 0, and this into my tax rate, which is 20%. It has resulted into deferred tax liability. So friends, this is how you should do the simulation. Don't just mugify and retrofy. So concept is that whenever the book profit is more than the taxable profit, it bound to result into deferred tax liability. Same with the case where the asset is being depreciated at the lesser rate, 10%, and as compared to the income tax which is being depreciated at 20%. So zahir si baat hai, my taxable profit is going to be less than what I've shown in my books of accounts. It also endorses one more fact that the carrying value will be naturally higher as compared to the carrying value as as per the income tax. So tax base. So this all corroborate one fact that yes, when the carrying value of the asset is more than the tax base, it results into deferred tax liability. Same is the case with the book profit is more than the taxable profit, it invariably results into a deferred tax liability. Don't come to this conclusion directly. You need to take into account many of the things, whether the taxable book profit includes the dividend income, which is going to be tax-free, and so on and so forth. But at the same time, you have to be very careful about the expenses. And following items will have the same tax base as the carrying value, penalties and non-deductible expenses and exempt income, thus resulting into a zero taxable temporary differences and naturally no deferred tax asset or liability. So taxable profit is lower as compared to the book profit. Taxable profit, that is the tax profit as per the income tax, is lower as compared to the book profit. It results into deferred tax liability. Here is, or to put it differently, book profit is more than is higher than the as compared to tax profit. Let's see, as per the tax laws, the deduction. Now this I'm talking about the expenses. As per the tax law, the deduction is allowed earlier as compared to the books. जैसे असीम जी क्या बोले आपने सर, पहले मार बाद में तार, क्या था सर? बहुत अच्छा था सर.
सर मैंने कहा था अगर अभी लूट है और बाद में छूट है,
हाँ,
you have to create a DTA, और अगर अभी छूट है और बाद में लूट है तो you have to create DTL.
DTL. No wonder बच्चे लोग आपके आशिक है सर. Good. And as per books, not considered to arrive at the book profit, but considered in the subsequent year. So there has to be a timing difference in all this. This is the analysis I've done for you, which you can definitely read at a later stage, because कुछ बहुत सी रोचक बातें मुझे कहनी है, जो मैंने कहा कि डिफर्ड अबाउट द लोन विच इज डिडक्टिबल और नॉट. सर एक बात है कि ये एक जो फैकल्टीज है ना, उसमें कीड़ा होता है सर. वो कीड़ा ये है कि अंत तक पढ़ते ही जाए, ये स्टेटमेंट पढ़ो, वो पढ़ो, ये करो. सर जो हमारा ये जो काम है ना, ये सब रिसर्च वर्क है सर. Now research work means what sir? आप किसी एक स्रोत से कॉपी करते हैं तो आप कहेंगे कि नहीं ये तो YMD ने कॉपी किया. बट YMD अगर 10 स्रोत से इकट्ठा करके आपको देते तो आप उसको क्या लाजवाब नाम देते हैं, सर ने YMD ने रिसर्च किया. तो ये मेरा रिसर्च है. That means I'm copying from many other resources sir. तो I was reading a very nice book, very lengthy book, जिसमें IAS 12 पे जो चैप्टर है, it's running into 200 pages. 200 पेजेस से IAS 12 का विवरण. तो ये बुक में इतनी छोटी छोटी बातें बारीकाई से लिखी है. I want to discuss those aspects with you, sir. So please allow me. This is easy to understand, and that's why I'm skipping it. But मुझे ये निकालना नहीं था, रखना था, correct? Because so that you can get benefit when you read this. Because जाहिर सी बात है कि this so-called intellectual property is going to be shared with you. Okay? ये आपको आपके लिए सर. तो allow me this, please. और recognition of current tax liabilities, and this is a very simple tax payable as per your return, and if you paid excess taxes it result into refund. But जहां तक current tax liability की बात है, of course ये पुरानी बात होगी, but फिर भी I found some at least 3 or 4 balance sheets making mistake in here. You know, in good old days, the income tax provision was considered to be a part of the schedule of provisions, and it was shown in the notes to the accounts. It was shown in the, it was disclosed, not presented. Now when I say disclosed not presented, means it was not presented on the face of the balance sheet, but now the current tax liability is to be shown on the face of the balance sheet. That means it is presented, not disclosed. Correct, sir?
यज्ञेश भाई आपकी आवाज थोड़ी सी कम हो गई है।
कम हो गई, क्या बात है, क्या ऐसा कहते कि मेरी एनर्जी लेवल डाउन हो गई? नहीं नहीं नहीं,
बस बस अब आ गया।
अच्छा अच्छा, नहीं नहीं आ गया। All right, thank you, thank you. Now, normally they say that yes, you have to take into account, you have to take the, you have to measure the deferred tax liability or asset, but there are certain exceptions. The initial, now this we are, this is, देखिए screen पे है, one is DTL and one is DTA. Now DTL में there are 3 items, and as far as DTA is concerned, there are only 2 items. And these 2 items are common. The एक item जो नई item है on the left hand side, which is concerning the DTL, is about the initial recognition of goodwill. So when the goodwill is initially recognized, and goodwill is recognized only in one case, and that's in the business combination, because goodwill is always acquired. Internally generated goodwill, we all know, is not recognized at all. Internally generated intangible assets जरूर recognize होते, but in goodwill nahi. All right, and from the initial recognition of certain assets and liabilities, so when you buy an asset, you don't create a deferred tax asset and liability, even if you're following the balance sheet liability approach. But वो वही किताब का जिक्र कर रहा हूँ जो तकरीबन 250 पेजेस बुक चेक फॉर ओनली IAS 12. इन्होंने एक बहुत अच्छी बात, रोचक बात बताई कि from initial recognition of certain assets and liabilities you may not recognize, but then later on at every year-end reporting period, whenever there is a difference in the depreciation rate or when these assets are revalued, you have to take into account, you have to measure the deferred tax asset and liability. They have given one very interesting example that I mentioned to you, that if an item is not deductible or not is exempt, tax exempt, that means technically they say the word that if there are no tax consequences, if there are no tax consequences of a particular transaction, then you don't need to recognize the deferred tax asset and liability. This happens, say for example, when you acquire an asset, उसका depreciation भी deductible नहीं होता है, और asset when you sell वो भी deductible नहीं होती cost. But later on this becomes deductible. Later on वो assets deductible हो जाता है from the tax perspective. So at that point in time, you need to also take into account the deferred tax assets and liabilities. At the time the transaction neither affects the accounting profit nor the taxable profit. ये मैं element की बात कर रहा हूँ. इस item, this item or the element of balance sheet, it becomes taxable or deductible later on, then in future you have to again account for the accounting treatment, and DTL and DTA you should recognize. Okay, from initial recognition of certain assets and liability except BC, except business combination. So asset can be acquired 2 ways, either I buy or I acquire through business combination. Now this exception is there for both DTA and DTL. So if I'm buying an asset, comma, and it is not a business combination, I'm not supposed to recognize DTL or DTA initially, unless it is business combination. So let me put it, I'm acquiring an asset in the business combination and not buying separately. The mode of acquisition is by business combination, hence I have to recognize the DTA or DTA. अब बात करते हैं goodwill की, that goodwill, in case of goodwill, DTL is not recognized. Now what is the logic of this? नहीं recognize करे वो तो मैं भी मानता हूँ, and DTA में ये exception नहीं है. This exception is confined only to goodwill and that to DTL. What is the idea? Naturally, when I recognize the DTL for or in connection with the goodwill, I have to create the DTL. The cascading impact or the corresponding impact is in goodwill itself and not in profit and loss account. So DTL में अगर recognize करता हूँ तो I'm artificially increasing the amount of the goodwill, and that's why conceptually दोस्तों आपको पता होगा शायद there is something called basis for conclusion. There is something called basis for conclusion, and this is there in part B of any standard. As far as Ind-AS are concerned, there is a separate section on the ICI side which has the basis for conclusion. And if you see Ind-AS, there is no separate section or the paragraph of the business combination starting with the abbreviation of BC, but it is there on the website of IC. Friends, law is not beyond the logic. In the same manner, accounting standards or the accounting treatments are not beyond the logic. Conceptually, if you understand the why or the reasoning of that, it will be very easy for you and you will not be resorting to ratify. So in sorry, you said something. Okay, fine. But this restriction is not there for the DTA. All right. A company acquired an intangible assets and for INR 100,000. It is a life of useful life of 5 years. No tax deduction can be claimed either as a license is amortized or when it's expired. Trading profits from the using license is taxed at 30%. The tax base is zero. Should DTL be recognized? The answer is no, because the no deferred tax is recognized because at the initial because it is the initial recognition. Because the assets initial recognition that arose from a transaction which was not a business combination. That means I acquired this asset which is not a business combination, and standards prohibits accounting for that also. Then the initial recognition of goodwill, taxable temporary difference is not recognized, that is prohibited, but DTA is allowed, sir. DTA is allowed, not DTL. And the subsequent treatment of the non-deductible goodwill, it all depends on the whether it is a deductible or not deductible. So the I think now in the income tax, the deduction of the goodwill is not allowed. Am I right, Asimji? This change has taken place from this financial year coming. That means the Finance Act 2021 has brought this change, if I'm not mistaken, that goodwill is now not deductible, right? Yes or no, Asimji? I think there is a change.
Amortization of goodwill had been restricted.
Restricted, yes, yes. And under the income tax act, it is not deductible now anymore, right? Okay. My good friend, this reminds me of a very good simulation. Yes, yes. Let me increase the font size. And this again is a last minute addition. जैसे कहते हैं ना कि हर एक faculty में कीड़ा रहता है कि last minute तक पढ़ के कुछ let me give something more and something better and something which is not there commonly in any other standards. Now this book is from the Brazil author. Okay. Now a company acquired a goodwill for rupees 10 lakhs rupees and the tax rate is 20%. For the tax purpose, it is allowed to be deducted at 20% straight. Income Tax Act allows 20% deduction for the goodwill. But goodwill acquired in business combination is not amortized. It is not amortized, but it is tested for impairment, right? But let us presume that it is impaired to 880 in the books of accounts, and as per the tax base, it is 800,000. So this results into taxable temporary differences, and you create a deferred tax liability. Again, now let us presume that no amortization, no impairment and no amortization, no impairment, and the goodwill is carried at the same 10 lakhs rupees. But for tax, the carrying value is 8 lakhs because deduction is 20%. This results into deferred tax temporary difference of 2 lakhs rupees, and then you are creating a deferred tax liability of 40 lakhs rupees. This is the subsequent treatment of a goodwill pursuant to the income tax deductibility, whether not deductible or deductible. I have given this example. Now, goodwill in business combination is we know that where the goodwill arises when the total consideration is more than the net asset. So deferred tax asset is prohibited. Now there is one thing which I added just about an hour back that discuss the pre-combination determination of DTA not included in the determination of goodwill. So in case of the business combination, if the acquiree has got some DTA, deferred tax asset, that will not go into the consideration of the deferred tax asset or the determination of goodwill account. So that means what it mean? So when you calculate, when you measure the goodwill, this DTA will be ignored for the measurement of the goodwill. A pre-combination determination of DTA is not included in the measurement in the determination of the goodwill, sir. Now, I have reproduced the paragraph 15b, which says that, and this is a very good example where there is an exception to there is an exception to an exception. There is an exception to an exception. In this paragraph, we say that the initial recognition of assets and liability in a transaction which is not a business combination and which at the time of transaction affects neither the taxable accounting profit nor the taxable profit or loss. So they say that you don't recognize the deferred tax asset or a deferred tax liability unless it is acquired in a business combination. But dear friend, there is one thing which is, for example, this is linked with Ind-AS 32, which says that the compound financial instrument to be accounted for using the split accounting. We know that pursuant to the Ind-AS 32, the compound financial instrument is to be divided, split into two parts: A, liability, and B, the equity. Liability is first measured, then the balancing amount is the equity. All right. Now the compulsorily convertible preference shares issued for the INR 1000 zero coupon rate and the market rate is 10%. So you have to then calculate the DTL because the 250 rupees is the equity portion, 250 rupees is the equity portion hypothetically, and that means this is divided into the 750. Our liability, CCP liability is divided into 750 and 250. 750 being the now new revised carrying value, and equity component is 250, and the tax rate is 40%. So you recognize a DTL at the beginning of 100 rupees. Next year onwards, it goes down. And if time permits, I have prepared a nice table, and this table is again extracted from the illustrations from the IS 12. Now, IS 12 requires the deferred tax to be accounted for such financial statement. Initial recognition exemption does not apply. So this exemption that initially at the time of initial recognition, you don't take into account the deferred tax asset liability is not applied. So initial recognition amongst the accountant is known as a RIE. RIE exemption is not applicable here. Now, then I have said something about discuss about the inception of loan with the tax deductible and non-deductible issue, that is taxable temporary differences. Now, this again has been added very recently at about just 2 hours back. While reading this a very detailed voluminous statement chapter on the IS 12, when a company normal, as I give the example, जिसका एक जिक्र मैंने पहले भी किया था, but अब दोहराता हूँ in detail. That for example, you issued 1 million, 10 lakh का आपने loan debt issue किए, and you incur an expense of 50,000 rupees for that. As per income tax, as per the IS as per the IS 32, you will not debit profit and loss account by 50,000, but you will reduce this from the carrying amount of the debt. And then you apply the amortized cost by using the effective interest rate method. So here, in this case, sir, in the very first year, this will lead to the deferred tax liability because your books in the books you not claim expense of 50,000, but your taxable profit, leave aside other things, will be lesser by 50,000 because income tax allows these expenses. So dear friend, here you have to create the DTL. And later on, sir, if you do a very comprehensive analysis, later on, because of the reversal impact, this detail will become zero at the end of the tenure of the loan. But essentially, what I wanted to discuss is that this IRE, initial recognition exception, will not apply to the compound financial statements. But in that case also you have to take into account. Don't forget that, and it is something which is very likely to miss your attention. Now here the standard has given that this differences arise in account of the timing differences too. Uh, um, this is the most common thing, sir. These are most common things, sir, and these I don't think we should delve much on that. That interest, one is taxable on the receipt basis, second is on the accrual basis, and depreciation rate was the most common thing amongst us Indians. सीधे करते थे depreciation as per the Income Tax Act, depreciation as per the books of account. Difference is so much, and then we are applying the deferred tax residual liability. That's fine. Okay, now. Development, these are some various reasons which are attributable or which are responsible for the deferred tax differences. Now they say that there are some many other reasons which leads to the temporary differences. They as per 103 business combination, no equivalent adjustment is made in the tax purpose. Assets are revalued and no equivalent adjustments. So जहाँ पे one-sided treatment होती है, whether devaluation or revaluation or maybe impairment, which is not allowed in the Income Tax Act, this will give rise to the temporary differences. They say that DTA arises on account of the deductible temporary differences carry forward the unused losses and the unused credits. And they say you have to be very skeptical about recognition of the deferred tax assets. Should be recognized, it is probable. Now they say very clearly that again this book, and I noted down this, they have not defined probable in the context of IND-AS 12 oblique IS 12, but then they say it is more likely than not. It's more likely than not. This is what they arrived at some conclusion. Though it is not defined, it means more likely than not. IS 12 has not defined probable in the context of this DTA. Correct. More likely than not. Yes, it is already there. A review of the carrying amount. Now, this we have to do since we are not recognized for some reasons the DTA and DTA. You need to keep on reviewing it. Friends, I must tell you one thing, that there is one of the criteria for recognizing DTA, even if there are losses, and that is existence of offsetable deferred tax liability. Existence of offsetable deferred tax liabilities. Friends, लोगों ने भर भर के प्लानिंग किया इस पे सर. At the time of first time adoption, बहुत I won't say unscrupulous, but जो भी कुछ है, they do fantastic planning by creating the deferred tax liability by revaluing the assets up, because उनको पता है कि 2 साल में DTA आने वाला है सर, because all this work of transition to Ind-AS was done in the hindsight. मुझे 2017 16-17 की बैलेंस शीट बनानी थी, 16-17 में फॉलो करना था, but I was doing it at the end of 16-17 only. फाइनेंशियली हम तो जगते लास्ट में ना, तब हमें बताया कि हमको एडजस्टमेंट करेंगे. सर लोगों ने बहुत भर भर के जो फर्स्ट टाइम अडॉप्शन का प्लानिंग किया था, माशाल्लाह सर, बैलेंस शीट का जहर निकाल दिया था विदाउट इम्पैक्टिंग द ईपीएस. सर बैलेंस शीट का जहर निकाल दिया था विदाउट इम्पैक्टिंग ईपीएस, एंड दैट वाज द, एंड फॉर दैट सर वो डेबिट क्रेडिट जनरल की एंट्री के लिए नहीं लोग पैसा लेते थे कंसल्टेंट, दे वर चार्जिंग फॉर दिस काइंड ऑफ प्लानिंग. सर आप कीजिए, मैं बैठा हूं, आपका ईपीएस को सुरक्षित रखता हूं, बिकॉज ईपीएस एक ऐसी चीज है जो कंपनी वाइफ से भी ज्यादा इंपॉर्टेंट देती है उसको, इतने संभाल दे, बिकॉज दैट्स एक ध्रुव का तारा जैसे उनको, they don't compromise with EPS, and people have done a fantastic planning, but for that you need to learn a lot and do some simulations yourself. Discounting prohibited, fine. Okay, now this is what they see the table. This is again from the book itself, from the IS 12 and IS 12. that sufficient detail is available. Sir, detail को plan करके बनाया गया था, detail को create किया गया था. माजू में सामने वाला 2 साल के बाद DTA आने वाला है. So I have to create a buffer for that DTA. So the sufficient DTA is available related to the same tax authority of for. That's why I use the word offsetable DTL. Probable sufficient taxable profit with the same tax authority fine. Tax planning opportunities available to create the taxable profit, sir. ये बहुत कुछ अपने आप में कह जाता है. And book में लिखा है सर ये. अगर ये possible है तो you recognize DTA, else you don't recognize the DTA. But if you not recognize DTA, then you must disclose this fact. Now the question arises where to recognize. We have with this OCI, and OCI is one additional factor, and secondly, sir, pursuant to Ind-AS 8, when an accounting policy is applied retrospectively, or when there is an element of financial statements restated, जिसे हम आम भाषा में कहेंगे कि rectification of an error, and if it pertains to a period beyond the comparative periods, then you have to not only recalculate the impact of the change in accounting policy or the rectification of error, but also you have to restate. केवल recompute नहीं करना है, restate करना है of the comparatives, and you have to give a more balance sheet, a balance sheet at the beginning of earliest comparative period. So in such cases, the impact of DTL, deferred tax, is recognized in the equity. Which is not the profit and loss, which is equity at the beginning of the earliest comparative period. So current tax and deferred tax is recognized as the income and expense, and including the profit and loss account, except when they arise from the these changes or other comprehensive income. In that case, net of revaluation, you've seen that statement that all item of other comprehensive income are presented net of taxes, either on the face of it or in the notes to account. And one very important thing, one area where DTL and DTA is recognized or adjusted against goodwill. They don't appear either in the profit and loss account or the equity, but that is adjusted against the goodwill. So business combination in which the tax amounts are recognized as deductible expense liability and accordingly effectively taken into account in the determination of the goodwill, applying the IFRS 3. This is what they say. In many cases, these liabilities are not affected by the fair value. So investment in subsidiaries, now this is the most commonly debated item, and I must tell you, sir, people have resorted to paragraph 40 and 41 of IAS 12, and which says that honestly, sir, I must tell you one thing, that as regards investment in subsidiary, associate, and even the DTL or DTL, it is not done that accurately. Now, the temporary difference arises on account of the undistributed profit, changes in the foreign exchange valuation adjustment, and the unrealized profits. Standards say that you have to recognize, but with an exception. Now, this exception is as under recognize DTL for all taxable temporary differences, except, now this talking about the DTL, the parent controls the timing of the reversal of the temporary differences, and it is probable that the temporary differences will not reverse in the foreseeable future. Now, this is applicable not just to the subsidiaries but also to the associates and JVs. JVs and subsidiary, we can always understand that there is an element of control, and which is controlled by the investor. But when it comes to the associate, I don't think the investor will have the power to control this aspect. Like the investor will have the control the timing of reversal. It will be there in subsidiaries and JVs, but in associate, this exception may not apply. So what do you mean? You have to recognize these differences. A parent control dividend policy of the subsidiary and is able to control the timing. The parent कहते हैं कि हमें dividend distribute नहीं करना है. I know when to distribute and not. And 99% companies are resorting to this for not recognizing the differences on account of this dividend and undistributed dividend. Now, as far as DTA is concerned, only to the extent it is payable. For DTA, it is no restriction. It has to be taken into account, but provided it is foreseeable. Now, it is measuring at what rate? The rate that have been enacted and sufficiently enacted by the end of the reporting period, And on the tax consequences, now tax consequences, that means the taxability of that particular element. Okay, now the dividend, the long-term capital gain is taxable, but otherwise there were three criteria: that long-term capital gain on the investment was not taxable. Second is it was taxable, and third was it is taxable at a lesser rate. Now this exists even today also, because short-term capital gain is taxed at 15% and the long-term is at 10%. But then, sir, some companies had planning. Now I'm telling you, expertise lies in application of knowledge. Some company had planned that they had created the deferred tax liability even in the regime when the long-term capital gain was tax-free. So then we argued with the tax expert of that company. I said, sir, Mr. Desai, don't forget that if I don't sell this shares on a recognized stock exchange, I lose exemption of the capital gains tax. And he made the company to say the company intends to sell these shares not on the RSC, not on the recognized stock exchange, but other than recognized, and then at that point of time it will be taxable. And hence they had created the deferred tax liability, again a planning. But then there were many other things. And one more thing, in this 10, any changes in the tax rate after the balance sheet period is not to be recognized into account. And this is what they say, the measurement and the manner of recovery. If you think that when I sell this asset is going to be taxed at 15%, then I have to measure the DTL and DTA at 15%. L as at 20%. Now, many companies have made these changes, sir. Many companies have made these changes when Honorable Finance Minister has introduced the tax regime of 25%, 25%, right? 22%, and 22%. So many companies which has provided for the tax at 35% or more, then they change it. So this is what they say, that the manner and the measurement of the recovery impacts. Then these are the accounting for the tax consequences, the same thing. It all depends and in what way you like this to be taxed, either at 15%, 20% or so. Now, this is one element which has been added since I think April 2019. Uncertain tax position identification. See, what is the normal procedure? You compare, you take up the balance sheet, you take up the tax base, and you find the temporary differences. You calculate the deferred tax asset liability as a case maybe. You file your return. The case is taken up for scrutiny, and the assessing officer makes some additions, disallowances. Now standard says they don't just make temporary differences in tax to create the DTL, but you also consider what could be the areas where they could be, the company's claim could be challenged, and there will be disallowance and all this. So they want us to go one step further and put ourselves in the shoes of the assessing officer and see that what kind of disallowances could be made or not. But friend, let me tell you, I have, for this, not only for this session, but earlier when this IFRIC 23, which is IS 12 was introduced, I studied the international annual reports and Indian. Mostly companies say that the company don't see any difference or any additional tax liability due to the uncertain tax position, because these are the gray areas where there's bound to be some difference of opinion by the assessing officer in yours. So there they say that you just sign and see the you apply the probability modules and calculate the probability of what could be the impact on the tax as a result of the uncertainty prevailing for the accounting treatment of certain items. There could be a situation when there is no changes in the temporary differences, no change in temporary differences, but still DTA and DTAL will undergo change, and that is when the change in the tax rate or the tax laws or the reassessment of the recoverability of the deferred tax asset. We have seen that there were losses, but now they are profits. So despite being no change in the temporary differences, entity is required to change the measurement of the deferred tax asset or liability, or change in the expected manner of the recovery of asset. You have planned that we'll be selling this asset, financial asset, at 15% short term, but that 1 year is over, and then it will be then becomes a long term capital gain, and then long term asset, and then the tax rate will go down. So these are the areas where there are changes in the DTA despite temporary difference being given in the same. And this is the presentation of the deferred tax asset. Offsetting is permissible only now in the income tax if there is a income from the income from other sources like horse race, lottery, and some kind of thing, and maybe your business income, or you have a deferred tax asset liability of the capital gains tax. Then you have to see that whether it is permissible or not, and whether entity intends to offset this or not. And these are the various disclosures, sir. Numerical reconciliation very important. असीम जी अगर आपकी इजाजत हो तो छोटा सा एग्जांपल ले लो ये कि I think it's already 6:30. So anyway, nothing much great. It's already there. I have given with the sir. Mute. असीम जी हाँ please.
एग्जांपल ले लीजिए.
चलिए. So this is the example for the consolidation, and you know that the common example, common consolidation treatment element adjustment is the URP, unrealized profit on the inventories which has been sold either by parent to subsidiary or vice versa and still in the group. H, an entity taxed at 30% has a subsidiary. H, an entity taxed at 30% has a subsidiary which is taxed at 34%. So H is being taxed at 30 and subsidiary is taxed at 34%. On 15 March 2015, H sells inventory with a cost of 1,20,000, giving rise to a profit of 20 and tax at 30%. And we presume that the inventory is still there in the group. So it is known as an unrealized profit. So what they do, sir, they have paid taxes on this profit of 20,000 at 34% 6,000. That's the current tax. What will be the treatment of the consolidation? So the profit made by S on sale to H will be eliminated. So the entry is debit the consolidated or the group retained earning and credit the inventory, group inventory. So at a group level, you are debiting retained earnings, group retained earnings. So you're reducing the group's profit by 6,800 rupees. And now that means what, sir? But income tax will not take cognizance of this. So your book profit is become lower than the taxable profit, giving rise to the deferred tax asset. So the in the group at a group level, the entry is the at the subsidiary level, the entry is debit current tax, that is the income tax, and credit the current tax account balance sheet. Right? This is payable. So subsidiary will pass an entry debiting profit and loss account by 6,800 rupees and crediting the current tax liability. Whereas at a group level, since the parent is being taxed at 30% at a group level, you pass an entry that deferred tax assets account debit 6,000 and crediting the deferred tax income statement by 6,000 rupees. So if eventually the group has an expense of 800 rupees, tax expense of 800 rupees, that is the sum and substance of this. And with this, sir, Simji, thank you very much for allowing me to take this last example. बहुत बहुत शुक्रिया. And आपने जो साथ निभाया इसके लिए बहुत बहुत शुक्रिया, sir.
It's always a pleasure to share a dash with you, sir. I'm fortunate enough to share dash with you on so many occasions, even in live and even at virtual platform. Always nice to have your presentation, and hope members have taken very good care of all these provisions which you have nicely explained. As far as consolidated financial statements are concerned, really we have to travel a lot now. We have to do a lot of research over it, because in India we do not have a group assessment, and as we don't have group assessment, we cannot be 100% aligned with the international financial reportings. So now it is very, I must say, I should not misuse anymore this particular dash when हम बोलते हैं ना पुरोधा होते हैं जो accounting standards के, Now he is with us, MP Vijayakumar sir. I think everyone sitting here knows who is MP Vijayakumar, and including me, we are all students of MP Vijayakumar sir since our exams of 22 years back when we have appeared for CA final examination. We had just two books in the market. One is for late DS Rawat sir, and other one is MP Vijay Kumar Saab. And MP Vijay Kumar Saab's book was very well known between those uh, aspiring chartered accountants who want to go logically along with the practical examples. So now the stalwarts of our profession is here. So let's not misuse any more this podium. And sir, really we are welcoming you here in this particular seminar. I just want to uh, ask management committee to kindly introduce MP Vijay Kumar Saab. I think Ashok Khaziwala is there to introduce MP Vijay Kumar Saab. Sir.
Asim ji, 1 minute. Can I take a minute? Namaskar Vijay Kumar ji sir. Namaskar MPV.
Yognesh, I was listening to you last 20 minutes.
Okay.
And as usual, you are full of style, you know.
No.
Like is your vocabulary and the delivery style. So it was very heartening to listen. Unfortunately, I had another session. Otherwise, I would have heard you fully. So thank you.
Good you didn't tell me, otherwise I would have got conscious, become conscious.
No. No. You're too humble. Please.
Thank you. Thank you.
Hello. Kirti bhai. I think there is some technical glitch.
Yeah, Ashok, Asim, if it's okay, I'll start. It's fine.
No, I'll introduce you, sir. MP Vijay Kumar sir is a great academician, as we all know, and he is also Atisha is there, I think.
Asim sir.
Yeah.
Asim ji, I have one question.
Yeah.
Asim ji.
Yes, sir.
I have one question with Yognesh bhai.
Yes, sir.
Can I ask?
Sir, Yognesh bhai, yeah, he's here. You can ask this question. Yes.
Yes, sir. Ask me the question.
Yognesh bhai, some of the companies are considering education sales and expenses, tax and duty liability, and claiming out of gross total income as an expense. But usually we consider this as a part of income tax. So
let me tell you. You see that education says some companies are claiming it as an expense, right? Okay. And not as let me tell you this about this. Honorable Manoj Fadnisi has shared one judgment. I'll find it out for you and I'll then send it to you because I know your email ID and I'll send it to the Indo branch, wherein Manoj Fadnisi has drawn attention to the fact that education says can be claimed as an expense. No, it's a Bombay High Court judgment.
Yognesh bhai, my question is that there are many judgment about it. My question is that whether we should consider it as a part of income tax or we should consider it as an expense item in above the line as a in profit and loss.
If you're claiming as an expense, then actually you will claim as an expense above the profit and loss account line item and not as a part of the tax.
Yeah, that a clarification. Okay, thank you.
Okay, yeah.
Thank you. Over to us.
Hello everyone, a very good evening and my regards to the learned speaker, MP Vijayakumar sir, CA Yognesh Desai sir, Asim Trivedi ji, Kirti Joshi sir, and all the learned members of present today for the session. I must say Yognesh sir has covered the most difficult standard in a very clear and precise manner, and we loved the way the interaction between Asim sir and Yognesh sir. Thank you sir for the session, sir. Now we have a next session on revenue recognition, which is the most important part of the accounting. It is the heart of the accounting, Ind-AS 115, that lays down the new requirements and rules of revenue recognition. News or significant that is different from earlier accounting standard that we used to comply. the impact is not only on the timing and amount on revenue recognition, but there is a significant and expanded presentation and disclosure requirements. Effectively, Ind-AS 115 has done away with the transfer of risk and reward approach, and they have introduced new 5-step model recognition. Let us understand Ind-AS in detail with the stalwart of our accounting profession. The next session is being taken by passionate, pragmatic, and envisioner and a proven executor, CA MP VIJAYAKUMAR sir. Then we have been reading him, listening him over the years, but still let me try my hands to introduce him. Sir has over 27 years of experience in industry as a chartered accountant in practice. He is currently CFO of various companies and chairperson of Accounting Standard Board, vice chairman of Expert Advisory Committee, and has been chair and vice chair in various boards like Valuation Standard Board, FRRB, Committee on Accounting Standard for local bodies. As a teacher and as a mentor, he has been teaching us over 20 years on subject of accounting and financial reporting and corporate laws. He has authored around 10 popular titles for CA professionals and students, which has a record of reprints over 15 years. So a multi-talented personality, a practicing chartered accountant, CFO, active members of ICI committee, teacher, and an author. Sir, we welcome you on behalf of the Indore branch. Handing over the session to you, sir. Thank you, sir.
Thank you, Atishay, for that kind words of introduction. Sincere thanks also to Asim for his very kind words which he had shared. Thank you, Asim. Before I go further, I don't know, I'm sure all of you are aware, Indore is almost the center of India in a sense, almost center of India. And it is a knowledge hub and a place for intellectuals. And 2 path-breaking initiatives associated with the accounting profession, both of them have their seeds in Indore. One is Ind-AS. It has been championed by none other than our own past president, Manoj Fadnis ji. In the development of the standards, the years which is spent in developing those as a member and thereafter as a chairman of ASB, and then it was just that God's wish that these standards should get notified when he was serving as the president of the institute. And what more can I say? Fine human being, and I'm thankful to him for this invite to be present here today. Second is on the code of ethics, which constitutes the heart of the profession. The erstwhile code, which was also aligned to the international code, had to be revised, and the international code got revised twice in between. One occasion we made efforts, but we couldn't synchronize it. But the second time around, we were able to complete the project on time. And that happened during Kemisha Ben's leadership. And Asim has been a key member of the institute in terms of capacity building on the new code of ethics across the country. In fact, code of ethics has been a subject where people who want to practice the profession very sincerely want to know more. And people who are fairly casual want to know to ensure that at least some mistakes they're avoiding. So in that sense, I think Hasim's time in terms of, I've seen his very unique style of communicating. His lectures are pretty unique. I heard him only once, but it was very appealing to me. I don't know if he recalls, he had been here to Chennai at a place called Mahabalipuram, where it was a full day event. It was a pleasure listening to him there. So both of them are structured there. So very happy to be back at Indore. Of course, I would have loved to be in person, but maybe some other occasion soon. I was also fortunate to listen to a most sought after speaker on accounting standards and audits and Ind-AS, Yognesh, a person full of style and happy I could hear the last 15 minutes of his address. So let me now come straight to the topic. Ind-AS 115, revenue from contracts with customers. I'll just share this slide. I think any sharing option needs to be enabled, Asim.
Yeah, it's enabled, sir.
It's enabled. It says, okay. It's, yeah. I hope this screen is visible. Yeah.
Yes.
So Ind-AS 115 on revenue from contracts with customers. As was mentioned during the introduction, while all aspects of financial statements are important, every element of financial statements are important, there are certain things which are like first among equals. There are certain things which are like first among equals. And when you talk about any organization, whether you want to understand its size or its performance, or you want to understand anything about an organization, one number which people would always refer to is the revenue number. So you don't identify an organization by the amount of property, plant, equipment, or by the amount of shareholders' funds, or by the amount of profit. An identity of an organization is typically based on, this is a 3 lakh crore revenue organization, 50,000 crore revenue organization, 5,000 crore revenue organization, 500 crore. So that number is such a very important number because it actually communicates much more than just what the revenue is and the profit is. It's a number which almost gives identity to an organization. And for many people who engage with an organization, that revenue number gives a direction. So from that point of view, while every element in financial statement is important, as I said, like there is always a first among equals, like the chairman of the branch, Kirti here. So while all of them are there, first among equals. So same thing applies here, and thanks Kirti for the invite. So revenue standard is so very important from that perspective. While I walk you through this standard, there's a detailed deck. I'll leave a copy of the deck behind to you. This deck has two parts. Part one is introduction of the standard, and part two is about 60 case studies or questions which have been picked up from the education material on Ind-AS 115, which help you get a better understanding of the standard and address all the practical issues. To the extent time is available, I'll cover some of those queries, but I'll be leaving a copy of the deck behind for you. A small caveat, whatever I would share over the next 75-80 minutes, all of these are my personal views, and none of them should be seen as views of any of the committees or boards of the institute I'm part of or of the council of the institute. Let me set the context with some fundamental things about accounting, which I believe, and these things you will find a connect when I speak about the provisions of Ind-AS 115. First and foremost, accounting covers both preparers and people who express opinion, that is auditors. And accounting, whether it is as a preparer or as an auditor, the term accounting is all about staying accountable. So I have prepared financial statements. I take responsibility for everything which is there. I am expressing an opinion on the financial statement. I offer myself to be accountable for every word which I express in the audit opinion. Second, the financial statements are the base. The accounting is the base for taxation, credit, governance, sustenance, investments. Thirdly, and equally importantly, financial statements, namely balance sheet, P&L, cash flow, is a communication. Audit opinion is a communication. Just like in our personal life, you and I want every communication we receive, whether it's from family or staff or professional colleagues, we want every communication we receive to be complete and truthful. On similar lines, the financial statement we prepare and the audit opinion we give on the financial statements should also be truthful and complete. And make a note, good accounting always leads to good economics. It makes lots of economic sense to have good accounting practices. I'd like to draw reference to the founder of the institute, late Sri G.P. Kapadia's words way back in 1949, which are still very relevant today as well. And I adore this person so much. And whatever I speak on 115, you'll find a substantial connect with these words from him. He talks about every learned profession should develop a sense of social purpose and social obligation. And this is more so in the case of accounting profession. And he goes on to say, technical excellence in performance of the functions and observing the highest in professional ethics is the foundation on which the future is built. As I speak, I will connect the provisions of 115 to his thoughts way back in 1949. This standard 115 has been notified by ministry as effective from April 2018. And this standard is based on the corresponding IFRS 15. And we have followed IFRS 15 verbatim. And this standard, when it was introduced, replaced two Ind-ASes which were there at the time. Ind-AS on construction contracts, Ind-AS 11, and Ind-AS 18 on revenue. It also led to withdrawal of a guidance note which we had on accounting for real estate transactions. So all of them have been replaced effective 2018. In fact, we have 3 years of post-implementation experience of this Ind-AS 115. It's important to understand the history of how this standard has evolved. It's so very important, very important. This standard, which replaced two standards, was the work of a joint project between International Accounting Standards Board and US Financial Accounting Standards Board. Both of them took upon a convergence project, and given the fact that revenue is such a very important number, it was important that these two popular accounting frameworks have a common view as far as revenue is concerned. So they finally were able to come to a common view. Standard was supposed to apply from 2017, but some transition related issues, eventually it hit the road globally from January 2018 and in India from April 2018. I just want all of you to also recognize that it's not just in India that we have at times postponement by a year and all. Even internationally, whenever anything new is introduced, the organizations don't hesitate to respond to the feedback. They don't hesitate to respond to feedback. So consequently, 115 was deferred globally by a year. And in fact, standards like 117, which is IFRS 17, have all been deferred by a long time. I'm highlighting this because at times I come across within our own members, people saying institute does not stick to the original planned dates. The reason is very simple, that we listen to the feedback on the ground And if the feedback is such that a year will make a difference for a better implementation, it's important to have that statesmanship to acknowledge that feedback and have a deferred applicability. We did the same with Code of Ethics also by a year, and we found a fairly innovative approach of holding back some clauses which we believe require much more understanding on the ground and to make it applicable later. Between IASB and FASB, they also constituted a transition resource group because you are moving from a particular accounting practice to a completely different way of recognizing revenue. I'll highlight two things here. Why such an important transition group was required. Construction contracts, earlier, all construction contracts were recognized only on percentage of completion method. That is over a period of time. But with this standard 15, IFRS 15 or Ind-AS 115, construction contracts, some situations you will recognize at a point in time, some situations you will recognize over a period of time. So that's a huge shift. Contrary to earlier, only percentage of completion. I don't know how many of you can recall the media coverage in 2018-19. There's so much of media coverage that for real estate developers and all, because of moving from percentage completion to completed service or completed contract method, effectively, there would be a drop in revenue, etc. So much of media coverage is there. That's a huge transition. Second major change here was all along revenue used to be recognized based on fair value. So when goods were supplied, service were rendered, the erstwhile standards required recognition of revenue based on fair value, but IFRS 15, Ind-AS 115 provides that revenue is to be recognized based on transaction price. So many have this criticism that IFRS is all or Ind-AS is all about fair value, which is not true. A number as important as revenue, the standard says transaction price is revenue. Transaction price is considered as revenue because typically between parties when you're transacting and there's commercial substance, that price is the best price to tell what is the worth of the goods and services which have been exchanged. So consequently, there is this huge shift which was done to recognizing revenue based on transaction price. So they had this transition resource group which worked for a couple of years to identify issues and give necessary clarity in the standards. From an IFRS 15 perspective, it replaced several standards and interpretations issued. Some of them were IFRIC, which were issued post 2000, and one was a SIC, which was issued prior to that. All of these are now subsumed and are part of Ind-AS 115. So this particular standard, to borrow the introduction, which is there from IASB, International Accounting Standards Board, it seeks to achieve 5 objectives. A, provide for a robust framework for addressing revenue-related issues. Increase comparability, which is a very important one. So inter-firm comparability is very important. Eliminate the need for complex and prescriptive rules. Rather go towards giving principles and give guidance in areas where earlier there was no guidance. For example, multiple element contracts, bundled contracts. There wasn't enough guidance. So all that guidance is added. And last and most importantly, enhanced disclosures. The moment we talk about a standard dealing with revenue, what strikes all of us is probably deals with recognition and measurement. That's what it strikes. But please note, this standard 115, the way I see it, this standard is a disclosure standard. There are almost about 20 paragraphs out of 130 paragraphs dedicated only for disclosures. The idea is to help the user of financial statement to understand what this number revenue is, the components of revenue, the judgments which have gone into arriving at that revenue, the amount of revenue which is likely to come in future for contracts which are yet to be completed, all of those disclosures. So please do not approach 115 as a recognition and measurement standard. It actually is a disclosure standard. And as preparers and auditors, I have this appeal to all of you. The financial statements are basically meant for users. And it's important the user of financial statement should understand. And revenue being such an important number, the components of revenue, the estimations and judgments in determination of revenue, all of that needs to be explained. And please note that as entities grow, there are lots of institutional investors who hold 10%, 20%, 30%, 40%, and they are educated set of investors who would like to understand an organization. Even if you take smaller companies, private equity, venture capitalists, and all, they would also like to understand. So the users want to understand those numbers. And in that context, it enhances disclosures. So this standard replaces those multiple standards, comes with a single standard. And unlike the earlier standard where revenue recognition was based on transfer of risk and rewards, here the focus is on control. The control should have moved. Please note, risk and rewards can be transferred by an agreement also. Goods are still with me only. I am the seller, goods are still with me. But by agreement, I can still transfer risk and rewards. So those cases, earlier revenue used to be recognized. But now standard says no. The actual control on the good should have moved to the other party. So if you look at consistently across all Ind-AS, control is such a very critical element for determining whether consolidation is required or whether the asset has got transferred. Even in financial instruments, 109 and all, it should have moved to the other party. And as I mentioned a little while ago, this standard gives additional guidance on several other items which wasn't there earlier. Now, as far as this standard is concerned, I'd just like to again spend a little time on context here. The provisions understanding becomes easy. The need for IFRS 15 or Ind-AS 115, which is a transformational standard, reasons which I articulated, was an imperative. It was not something which was a wish list. It had to happen, and it was long overdue. And as far as users of financial statement are concerned, I'm leaving this thought with you, and it's important as we go into the next decade and decades of reporting. Past, the focus on financial statements was all historical information. Kal kya hua? That was the focus. And recent past, maybe the last 20 years, the focus is on what is it now? What is it now? So in the balance sheet today, what is the value? What is the fair value now? But the direction going forward is giving information which helps a user to forecast. The users, I have interacted in international forums and other forums. Most of us interact with preparers and auditors. But please note, preparers and auditors are a community who have to serve a users. So whose views are relatively more important is the user. So similarly, when you cook a food, it's about the user. He has to feel happy about it. He should feel it relevant. And as far as the users are concerned, they are extremely clear in their mind that they don't want historical information. They want financial statements to give information which has a predictive value, which can help them to forecast, help them to understand tomorrow. Very simple example. If you and I want to lend money, we lend money not based on past laurels. We lend money based on what is it for the company in future. Same with investments as well. So when it comes to you and me, it is futuristic. The same applies to other users as well. So this standard 115 has those elements of disclosure which help forecasting, So this standard is a step in that direction, That is why I tell this standard is more a disclosure standard rather than a recognition and measurement standard. The standard comes with a whole lot of challenges because it's a principle-based standard, and a single standard seeks to address accounting for revenue across multiple geographies, different state of economy, developing, developed, underdeveloped, different regulatory environments, different industries. All types of revenue you're trying to cover in a single standard. Just go back even 5 years in time. In 2015, if I told you construction contracts and sale of goods, I'll combine and have a single standard, I don't think any of us would have accepted. But today, that is the reality, that it is a single standard which deals with all revenues, whether it's construction or manufacturing or trading or services. All of them is covered by one set standard. And for this standard, there are lots of judgments involved. And for those judgments, unless there is very good internal financial controls, it's very difficult to give an assurance that the consideration has been allocated properly and revenue determined on a proper basis. And also, please note, and you'll see it as we go along, this particular standard provides that, and rather it recognizes that if you want to recognize revenue, there should be an enforceable contract. Enforceable contract as per the laws of the land. So a particular contract, an agreement, could be enforceable in law in one country, may not be enforceable in other country. So the revenue recognition starts based on an enforceable contract. So if you're supplying goods to some other country, and it's important that you should know, if you have given jurisdiction as that country, whether those country laws allow you to recognize it as an agreement. Similarly, while determining performance obligation, this is a very important point. So you cannot recognize revenue just based on, I have done this, so I'll recognize revenue. No. There is a contract which requires me to do 7 different things. 7 different things. I have completed 3 of them. Can I recognize revenue? The answer is yes. If these 3 things are useful to the customer for him to use. If the customer does not find use with the three things you did, you cannot recognize revenue. So in all construction, all contracts with customers, if there are multiple obligations, multiple things to do, you can recognize revenue only by understanding whether the obligations you performed are useful to the customer. So which means as a preparer, as an auditor, I should know whether the customer is in a position to use what I have done, what I have supplied. Only then I can recognize. It's not easy. And for this, it requires good amount of skill sets to understand the customer's environment. Lots of estimate and judgment. Some of us might criticize why judgment, estimate and all. But friends, let's understand the beauty of this profession. Like some of the good professions is the ability to apply professional judgment. If everything was so rule-based, there is a possibility of misuse, and there is also nothing exciting for us. So the standard involves quite a good amount of judgments to be made, understanding of the transactions for recognition of revenue, and lots of disclosures. Very critical market information also needs to be given. If there's a contract with me, which I have to fulfill over the next 5 years, let's say a construction contract, L&T, I have to fulfill over the next 5 years. This year, I recognize so much revenue. I should disclose that there is so much more revenue belonging to the next 4 years. I have to disclose that. So those kind of disclosure requirements have been prescribed. And transition was a major challenge, but we are now passed with this transition standard. It happened in 2018. These slides I'm not covering, but when I leave a copy, you can go through. So I now come to the core of 115. Objective of 115, and follow these words very, very carefully. And on revenue standards, and generally for standards, more important for revenue, my request to all of you is that when you are deciding on an accounting treatment, just go by common sense and what you believe, what comes to you first. 99% that is the correct accounting treatment. 99% that's the first correct treatment. The moment you start working towards a particular type of recognition, the moment you start thinking that this is how I want to recognize revenue, those cases you are likely to end up with a wrong judgment. You will see the examples as I go through. I may not be able to cover all of them, but it's there in the deck. I'll send it across. And it's there in the education material. It's not my discovery. You'll find every practical live example which is here. All of them just apply common sense. Forget para 9, para 15, para 34 and all. You'll come with an outcome which will exactly be the same as what is prescribed in the standard. So this standard seeks to establish the principles important, which an entity shall apply to report useful information to users of financial statements about three things. What's these three things? Three things you have to report. Nature of revenue, amount of revenue, timing, and then the cash flows. So this entire standard focus is just to give principles from user's perspective. It's not from preparer's perspective. Remove that preparer's perspective in your mind forever. Standards are not meant for preparers. They are meant for quality financial statements for a user. And for the user, he has to understand three things about the revenue: the nature of revenue, manufacturing, services, construction, whatever it is, amount of revenue, timing, and also uncertainty, etc., and the cash flows which will arise from contract with customer. All of these are sought to be addressed in this standard. This standard does not apply for leases. Lease also you have a revenue. Operating lease and all, you have a revenue. For leases, it's covered by a separate standard. There are income like interest income and all, which is covered by a separate standard on financial instruments. Those are also excluded. Insurance, highly specialized, covered by another standard. So those are all excluded. Look at the last box on the right-hand side, bottom quadrant. This is important. Non-monetary exchanges between entities in the same line of business to facilitate servicing to the customers or potential customers. Let's take a very simple example. You have a fuel station, Indian Oil fuel station. There is a HP fuel station, petrol bunk. Very simple example. I'm oversimplifying it. Now for you and me, psychologically, going to HP bunk or going to BPSL bunk, we are used to it. Like my father always used to go to a particular bunk. He will not go anywhere else. But the oil is exactly the same. It's exactly the same. So what the standard provides is, if between oil dealer A and oil dealer B, if dealer A has shortage of oil for that day, truck आना है, truck शाम को 10 बजे आएगा, रात को 11 बजे आएगा, उसका स्टॉक 200 लीटर कम है, 500 लीटर कम है, और HP bunk 100 meters away है. So those cases, I agree that I will take 500 liters and use it here. So I'll take it and I'll tell him that जब रात को ट्रक आएगा 500 लीटर आपके पंप में डाल दूंगा. So that is a case of a non-monetary exchange. So oil dealer A and oil dealer B limited, A limited, B limited, they cannot show this 500 liters of oil as a revenue. No, it is a non-monetary exchange. हमने दोस्ती से adjust कर लिया. So non-monetary exchange conditions are important. Same line of business. That is important. For example, let's take an example where I am in telecom business and I have lots of these towers and all where electricity is consumed, a reasonable amount of electricity is consumed. So I can have a deal with the electricity company, Tata Electricity, Tata Power or Reliance Electricity, whoever, or Adani. I can have a deal where I tell that I will give you so much talk time for all your employees and you give me power for these facilities. So that is also non-monetary exchange, but that will be covered by the standard where the telecom company will show as revenue for talk time. Power company will show revenue for the power supply because they are not in the same line of business. So non-monetary exchanges, if you are in the same line of business, and it is on a timely basis. There's one more condition. Please note, it is not open. So it's not like I take 500 liters of oil now and I'll give you after 10 days. No, that will not be covered. In such a case, that 500 liters of oil which B is giving to me will be shown as revenue because there's a financing element, price risk involved and all. So if it is settled on a timely basis, which means almost immediately, then it is outside the scope of the standard. Take, for example, in the telecom business, between Jio and Bharti or Vodafone, there are some minutes which originate in one place, land in another place, and vice versa. Every month, they will exchange a statement that my traffic in your network so much, your traffic in my network so much. Every month, net number of minutes they'll agree to settle. That is covered by 115. Those are not excluded. Those are not excluded. So I am allowing minutes to go to you. You are allowing, I am allowing your minutes to come to me. Those are all revenue transactions. I will show as revenue and cost separately. That is not exchange. Exchange means aapne diya, main wapas kar liya. Barter, those kind of things alone will be scoped out of the standard. Now, as far as the standard is concerned, from a scoping perspective, one more very important point is the following. There would be some instances where the revenue is a bundled revenue. Take, for example, loan. When a loan is given, there's a processing fee, etc., etc. So those processing fees, commitment fees and all, many times those fees are integral part of the effective rate of interest calculation. But sometimes it is an independent transaction. So what 115 says is, if you can separate it, then account it under the respective standards. If you can't separate, then apply 115 for the contract. The core principle of the standard, and this is what is popular, and every time you talk about Ind-AS 115 or IFRS 15, people will talk about what is called the five-step model. So the standard provides that you can recognize revenue to the extent of what you are transferring, goods or services you are giving, whatever you have promised. Recall contract agreement, contract act agreement, go back to basics. So it's basically promise done, promise received. So whatever promise I've given, I will give you goods, I'll give you services. For whatever I've promised when I'm transferring, I have to recognize revenue at an amount which reflects the consideration, transaction price, for which I'm entitled to receive. I can recognize to the extent I'm entitled to receive for those goods. And for this, the standard prescribes this five-step model. For those who are preparers, you should have an internal financial control process in your organization where for all the revenue you recognize, there should be an internal financial control process which takes through all these 5 steps. And for an auditor, the audit working papers should carry enough evidence of the fact that for the revenue which you are giving assurance, these 5 steps have been followed by the organization concerned. The 5 steps are: 1, identify contract with customer. There's lots of guidance there. Some bit I'll cover now. 2nd, in the contract, identify what are the performance obligations. Most likely, performance obligation is a single obligation. I will give you this item, I'll give you this service. But more often than not, there are multiple promises you do. You do promises like, I am selling you this television and I will ensure I'll give you a product warranty of 3 years. So there are 2 performance obligations. Sometimes there can be a 3rd obligation. I will install it also. I'll install it. So typically contracts with customers, obligations can be sale of goods, obligation can be installation and commissioning, obligation can be service obligations after that. So all these obligations you need to identify. Then what is the transaction price? This transaction price we have to then allocate among the obligations. So transaction price is X currency units, 3 obligations. So how much of this transaction price belongs to first obligation, second obligation, third obligation? That guidance is available in step number 3. Step number 4, you allocate it to each of them once you determine the transaction price. And lastly, recognize revenue. Some cases, revenue is recognized after you have completed the activity. Some cases you recognize over a period. So in the language of the standard, it's called recognition of revenue at a point in time or over time. So at a high level, we are all used to thinking like completed and proportionate completion, but that jargon is not relevant now. The relevant jargon, the relevant terminology is at a point in time versus over time. So how do we recognize revenue? So these are the 5 steps. So every contract with customer, you have to necessarily go through this 5-step model. So let's go through each of them and understand some of the key steps. Step number 1, identifying a contract with customer. And for this, coincidentally, there are 5 elements again. 5 elements again. First and foremost, for something to be contract, recall we discussed earlier that it should be enforceable in law. When is it enforceable? When there is consent, consensus ad idem, there should be consent. So both of us should have agreed. That agreement can be in writing, or it can be oral, or according to customary business practices. Majority of cases, it is in writing. But please note, you and I also do a lot of oral contracts. Recall all this telecalling activity which happens, where in the telecall itself, you tell that, okay, mera card upgrade kar lo, mera insurance premium ke ye rider add kar lo. So you are telling all those are oral, and so those are also enforceable. So it can be in writing, it can be oral, or in accordance with customary business practices. There are certain business practices like, I will leave some goods with you. If you are not returning it over the next 2 weeks, or if you are consuming it, to that extent, it will be treated as sold. So first element is there should be consensus ad item between the 2 parties, written, oral, or business practices. Second, the contract should be such that you are in a position to identify each party's seller buyers rights regarding the goods and services. So what are the rights of the seller, rights of the buyer? So you should be able to identify those rights in the contract. Third, clarity on payment terms. Clarity on payment terms. If payment terms are not there, you cannot recognize revenue. Clarity on payment terms important. Fourth, contract should have commercial substance. So commercial substance would mean other than gifts and all. So there should be risk of money collecting, not collecting, performing, timing of delivery, how much amount you are likely to get. So all those commercial risk elements should be there. There should be a commercial substance. And lastly, there should be a probability that you will be able to collect the money for the goods and services which you are providing. If all these 5 elements are there, then you conclude that there is a contract with the customer, which is your step number 1. Step number 1 in your 5-step model. And there are examples here, which more or less I have covered with different examples, so I'll skip that. And on this identification of contracts, some very interesting principles. Three principles, para 13 to 15. First and foremost, if at the inception of contract, you have concluded that the contract is existing, signed by parties, the 5 conditions are fulfilled. At inception, all 5 are fulfilled. Then you should not revisit it. You should not revisit it. Once you have concluded that there's a valid contract, full stop, no revisiting. So if there is uncertainty of collection coming later, that uncertainty will be treated as a bad debt and not as a revenue recognition issue. That's point number 1. Second is, you had a contract, but it did not fulfill the 5 conditions, any of the 5 conditions. So those cases, you have to assess on a continuous basis when the conditions will be fulfilled. So I'll keep watching. Uncertainty of collection, when is it getting removed? I'll keep waiting. Once the 5 conditions are fulfilled, at that point, I'll cross step number 1. There's a third element. The contract never meets the criteria. 3 situations. Recall. 1, initially I fulfilled all criteria. Excellent. Second, initially I did not fulfill, but later I fulfilled. Good. Third, it is never meeting the criteria. Customer gave me an advance, 30%, 40%. After that, not to be seen at all. Because he believes that's a better loss than buying the product and he's suffering a loss. So those cases, there is again guidance on how to recognize revenue. So those cases, if I have delivered, I have done almost whole of the work, I can recognize, or the contract has got terminated to the extent of money received, I can recognize the revenue. So identification of the contract, these are the criteria which I just talked to you. It meets criteria initially, does not meet, I continue to assess. And if it meets, I'll recognize. If it doesn't meet, then at a later point of time, to the extent of whatever money I have received, I will recognize the revenue. Now, if you recall Ind-AS 11 or even AS 7, Ind-AS 11 or even AS 7, we come across these principles of combining contracts and segmenting contracts. Some cases contracts are combined. Some cases the contracts are all separated and accounted. So this standard has exactly the same provisions where I can have 3 individual contracts. Some situations I should combine it, treat it as one contract and account. Some cases I should account as 3 different contracts. I'll give a small example. Let's assume you are having a parcel of land, yourself, your brother and sister. You want to construct 3 apartments, first floor, second floor, third floor, ground floor parking, 3 apartments. So all the 3 family members sign a contract with a developer, with a construction company. All 3 of you sign a contract, 80 lakhs each for constructing this apartment. So even though there are 3 contracts, for the construction company, it is 1. Because it's a single building, there's interdependency. The commercial value has been arrived on project as a whole. So even though there are 3 individual contracts, the standard requires you to combine it, treat it as one single contract. That is called combining. Same principles are there in AS 7, nothing new. Second is, there can be instances where, let's assume the Municipal Corporation of Indore is inviting tenders for constructing 3 flyovers across the city. Location A, B, C. Now, when you have these 3 flyovers being constructed, I am L&T, I bid for it. I bid for flyover 1, flyover 2, flyover 3. Fortunately, all the 3 flyovers I won. And I have a contract signed. So those cases, the commercials of each flyover are independent. Even though I sign single document with the Municipal Corporation of Indore and a function is held, these are 3 separate contracts which I should segregate and account as 3 independent contracts. The flowchart is as follows. I have explained the flowchart in a sense. Negotiated a single package with a single commercial objective, then combine it. Amount of consideration for one contract is dependent on the price or performance of the other, then also combine it. Some of the goods or services in a contract are necessary to be combined with another, then also combine. Otherwise, you have to treat them as separate contracts. Then we have this beautiful guidance on modification of contracts. In life, as you do business over time, some contracts are bound to get modified. Take, for example, I have a contract with my security guard company for 5 years, providing security personnel or cleaning personnel. So whatever contracts are bound to change. Now, 2 years have passed by. I am a security company. I provide security to you. Current contract is I should give you 10 people. You come in 3rd year and tell, give me 2 more people. So which means scope of that contract is increasing and the price for those 2 people is independent of the price for 10. Then this 2, I'll treat it as a separate contract. If the modification is obviously not approved, then I will not recognize, assuming these are approved. Second is 5-year contract, 2 years are already over. Now, 3rd year, I renegotiate and tell I'll take 2 more people and I will elongate the existing contract for another 2 years, make it a fresh 5-year contract with revised prices. Then existing contract is terminated and revenue will be measured by the new contract of the 10 plus 2, 12 people for the 5-year period, and then you will determine. Last case is the remaining goods or services. You want a person to work an extra shift or a person's profile to be changed. So currently I have a security guard in the age group 50 plus is okay. But now I tell no, I want somebody 40 plus, 40 to 50 age. So those cases, the modification is treated as part of the existing contract. So contract modifications, not approved, ignore it. If it is approved, then you have to see whether it is increasing the scope or not. And based on which you decide the accounting treatment. And for this, we have a couple of examples here. Step number two is identifying the performance obligations in a contract. So every contract, there could be multiple obligations. If there is a single obligation, life is simple, life is very simple, but more often than not, you will have multiple obligations to be done. I sell a product, there is installation and commissioning, and there is a post-sale service to be done. So those cases, I should identify all those services separately, all those obligations. And I need to identify who exactly is my customer and what are those distinct goods and services. So the standard gives a beautiful guidance which says, the example I gave you 3 obligations. It says the good or service should be distinct enough, which means the customer can use that good by himself or with the resources at his access. For example, I am selling a air conditioner. That air conditioner, customer can install by himself if he has engineering capability, or engage a local engineer and do it, or take my support for doing it. Then it is a distinct good. But suppose it is an air conditioning which is so customized, like I prepare air conditioners for installing in a shopping mall, for installing in an airport. So those cases, customer cannot appoint anybody and do it. Only I have to do it. So those cases, the supply of air conditioning unit and the installation and commissioning will be together treated as single obligation. So first example, supply of air conditioner is a one obligation, installing is another obligation. Second example, both of them together will constitute a single obligation, because in the second example, I send him the equipment, some other person can never install, only I can install. That equipment has no relevance to the customer, and those cases, both of them will be treated as one single obligation. So identifying performance obligations, one criteria is the goods or service is capable of being distinct. Please note, as a company, it is still three obligations. As a company, it is still three obligations. But in the second example I gave you, the two of them will be combined and treated as one single obligation for the purpose of IFRS 15. Second is, the promise is separately identifiable. So it's not just that I have to do it, I should be able to identify the promises separately. If these criteria are fulfilled, then you arrive at what are all those performance obligations. While on this, a little bit of discussion around warranties. Warranties, as all of you are aware, there are broadly two types of warranties. One is called service warranties. Second is called assurance warranties. Service warranties are what you can buy. For example, I buy a car comes with 1 year warranty, but I can buy extra 2 year warranty, extra 4 year warranty. Those are called service warranties. That will be recognized as revenue separately. But that 1 year which is bundled is an assurance warranty. It's like a promise that what I gave will work. So those assurance warranties, accounting will be done as per Ind-AS 37 and in our accounting standard 29, AS 29, where you create an obligation for the liability which may come up. So as far as warranties are concerned, the accounting depends on whether it is a service type warranty or an assurance warranty. Service type warranty, it is revenue. Assurance warranty is not revenue. I have to only make a provision for liabilities which I need to make. Now, so identifying the performance obligations, we discussed some guidelines, and while doing this, as I just mentioned, I gave that example of air conditioning in an airport or a mall. Recall the example, I give you two obligations: supply of goods, installation and commission. They'll be treated as separate obligation if I can deliver individually, and customer has a choice of getting it installed by anybody else. Then I'll treat it as two obligations and recognize revenue separately. Recall I told about nature of revenue. I'll show sale of goods revenue separately, installation revenue separately. But the second example, both of them, there is a significant integration. The modification or customization I need to do, they are highly interdependent. Then they'll be treated as a single performance obligation and I'll show it as one revenue line item, one revenue line item. Now, for which I've added a couple of examples here. Step number 3 is determination of the transaction price. This is important. For those who are familiar with Ind-AS 11 or AS7, Ind-AS 11 or AS7, recall that construction contract and all, the revenue, contract revenue includes revenue from the contract, claims, bonuses, all those also are added on exactly similar here. Transaction price here is what you have agreed with the customer, and you should include in its determination what is called variable consideration, what is called non-cash consideration. At times you pay amount to customer. At times we pay amount to customer. How do I adjust that? If there is an interest element, significant financing element, how do I handle? So transaction price for all the obligations together, transaction price, I should include all of these elements in arriving at the same. Let's discuss a few elements. Variable consideration, interest element, non-cash consideration, consideration payable to the customer. Let's discuss these elements. All of these together constitutes the consideration. As far as variable consideration is concerned, I'll give a simple example. Variable consideration is, I sell something, the contract is such a way that if during the year the buyer buys more than so much, I'll give him a 5% discount. I'll give him a 10% discount. Similarly, there can be contracts like, you can recall the golden quadrilateral during Mr. Vajpayee's period, golden quadrilateral. If you complete the contract 1 month before the scheduled date, you'll get so much bonus because the road is open, toll road collection start 1 month early. So I'll get a bonus. So those are all called variable consideration. So in the case of variable consideration, the standard says you need to estimate how much of that consideration you're likely to get, include it as part of your revenue number. And there's a guidance on how to arrive at that amount. There are two situations. What you see bottom left-hand side and bottom right-hand side, there are two situations. One is a situation where there are multiple possible outcomes. So if I achieve 60%, I'll get this. If I achieve 70%, I'll get this. 80%, I'll get it. Then I need to apply a probability theory, arrive at an estimated amount. Second is situation where it's like black and white, yes or no. If I achieve, I get, otherwise I don't get. So those cases, what is the probability of happening, non-happening? And then I determine. So one is a range of values. Another is yes or no probability of happening. So based on that, you arrive at estimated amount and include it as part of your transaction price. But there is what is called constraining estimate of variable consideration. So there could be some instances where you estimate you will get, but there's a probability that you may have to refund it back. You thought in most likeliness you will do. So the standard tells, look at your past experience, factors from outside the organization, look at all these factors before you conclude on the recognition of the variable consideration. Significant financing component. It can happen two ways. It can happen. One is I give extra time to customer to pay, and there's an interest element which I get. Second is customer pays me in advance and I deliver later. So there's an interest element. So both cases, the standard says interest element should be segregated and shown separately in the income statement, And if the goods or service are getting delivered within 1 year, we are aware across all standards, we consider time value of money only if the contracts are for more than a year. So here also the same practical expediency exists. And one very good guidance available here, which was not so very clear earlier, is all of us have this experience where, particularly government projects, when you receive money over a 3-year period. Every time you get, the government holds back 5%, 5% they hold back, and they'll pay it 2 years after handing over. So for that, should we do a time value adjustment? The answer is no. So that money is held back for your obligation relating to assurance for performance. So no time value adjustment is required there, and that guidance is available in the standard. So I'm skipping that further discussion on that. Next is step number 4, allocating transaction price to performance obligations. Let's take that simple example I'd given you. 3 obligations are there: supply, installation and commissioning, and post-sale services, repair services, post-sale, warranty. 3 obligations are there. So the total transaction price, you have to allocate it among all the 3 by following principles, which we are fairly familiar in the context of business combinations, amalgamations and all. Ind-AS 103, IFRS 3 and all. Suppose I acquire a business and consideration is 100, and there are 5 or 6 assets I've got. The consideration should be allocated to the assets in the ratio of fair value. That's called purchase price allocation. Same logic here also. The transaction price I should allocate to the 3 obligations in the ratio of the individual obligation standalone selling price. For example, standalone selling price, goods 10 lakhs, installation 3 lakhs, post-sales warranty support 2 lakhs, 15 lakhs. If I sold separately. But because it's a combined one, my price is 14 lakhs. So 14 lakhs will be allocated among the 3 in the ratio of 10:3:2. But some cases there will be evidence that this 1 lakh price discount I gave is attributed only for the product. For product, I run various offers and product belongs to the product. Those cases, I will adjust this entire 1 lakh against product 10 lakhs. The remaining 3 and 2 will get recognized. So standard gives guidance on allocating the transaction price among the various performance obligations. Last step, crucial step, is recognizing the revenue. We have so far crossed 4 steps: identifying the contract, identifying performance obligations, and please note there, customers' usage behavior of the asset is very important. Identifying transaction price, variable consideration, financing element, non-exchange, non-monetary exchange, all that stuff. And 4th is allocating transaction price to the different performance obligations. Now comes recognizing revenue. For recognizing revenue, there are broadly 2 situations. One is where you recognize revenue over time. Second is you recognize revenue at a point in time. For example, I am doing accounting services for somebody. Revenue is recognized as I keep delivering the service and the person consumes the service. So that is over time. At a point in time, I have to supply some goods, the other person gets control, then I will recognize revenue. That is at a point in time, at a very, very simplistic level, but there is beautiful guidance available here. Recognition of revenue over time. There are 3 elements which are given for guiding, and at a point in time, there are 5 elements available for guiding recognition of revenue. Let me walk you through those 3. Revenue recognition over time. What circumstance I recognize revenue over time? One is customer receives and consumes it as I give. So I give accounting, they're benefiting. I give security guards, they're benefiting. I give cleaning staff, they're benefiting. I'm providing food, they're consuming. So as they give and they're benefiting, those cases over time. Second is, on your land, I am constructing a building. So that building, I am not going to have control. You will have control. So I am constructing something, but it is enhancing an asset which belongs to you. Land belongs to you. Those cases, again, revenue over a period of time. Third, I am doing something. I am a company who is selling goods or service. I am doing something for which there is no alternative use, and I have an enforceable right to get money. Take for example, you have employed me for designing something or building, constructing a machine. I am BHEL. You wanted me to construct a machine. So this machine which I construct, I have nothing to do with it. It is based on a design meant for you. And the contract provides that I will be entitled to money for whatever performance I have completed. 2 important things. Principle of quantum merit. For some reason, there's a default. I am BHEL. I completed 60% of manufacturing the machinery. Some breach is there. I should be able to collect cash equivalent to 60%. If I am not able to collect equivalent cash, then revenue will be recognized only after delivery. But if I am constructing something for which I don't have an alternate use, I cannot use it for anything else, and I am eligible to get proportionate amount, these 3 situations, revenue should be recognized over time. That is over a period of time. Only 3 situations. So ज़्यादा दिमाग रखने की नहीं. Only 3 situations, and so very simple situations. Then recognition of revenue at a point in time. At a point in time, look at these 5 conditions. Right side of the chart, bottom, 5 conditions. I can recognize when control is transferred, for which my guiding principles are: 1, I should have a right to get payment for the asset. Customer should have got legal title. Physical possession should have got transferred. Customer is entitled for risk and rewards of that ownership. And customer has accepted the material. So if all of these conditions are there, it is a demonstration that control has moved, and I can recognize revenue at a point in time. For real estate developers, earlier we had a guidance note which is now withdrawn, and we have to apply these principles of overtime or at a point in time, which we just spoke. Then let me come to concluding as we're coming to close to the time. Maybe I'll cross about 5 minutes, Asim and Kirti, maximum 5 minutes. In this standard, there is provisions relating to what is called contract cost. Just like we have in AS 7, Ind-AS 11. So what constitutes a contract cost? Because you have to match your revenue with the cost. The costs are broadly two things. Incremental cost to obtain a contract. I have a sales and marketing team that for winning contracts, that cost is my cost of running operations. That is not a contract cost. But if I pay a sales commission for getting this particular contract, that incremental cost will be treated as part of contract cost, and the contract requires revenue over a period of time. This sales commission also I can amortize over a period of time. Second is costs for fulfilling the contract. So whatever direct material, labor, and all those costs which I incur and I intend to recover from completing the contract, all those will be treated as contract costs. Why this definition is important is because contract costs, until revenue is recognized, is carried in the balance sheet as an asset. And if there's a recoverable issue, there's an impairment to be provided as well. And if those conditions have improved, you can also reverse the impairment too. So from that sense, contract cost determination is important. And lastly, presentation requirements. The right to receive consideration will be shown in the balance sheet. Contract costs and contract liabilities, if any advance from customers, to be shown separately in balance sheet. As I told you, this standard is largely a disclosure standard, and almost about 20 paragraphs are dedicated for disclosures as to disaggregation of revenue, judgments which you have applied in identifying performance obligation, allocating transaction and revenue transaction price among the obligations, all of that stuff. So all these disclosures need to be made. And given time, I'll just spend a moment on this software. So we have this software contracts where there is a license is sold. Second is where you use software as a service, where license is sold, revenue is recognized for sale at a point in time, where software is given as a service, like your Microsoft O365 cloud and all. So those cases, revenue is recognized over a period of time as the consumption happens. We had one instance of an EAC opinion in the context of real estate industry. And here again, the EAC opinion, brief facts, EAC opinion. The question was, should we recognize revenue after the units are handed over to the customers or over a period of time? The conclusion was, if the contractor does not have an alternative use of that particular asset and he can enforce proportionate revenue collection for work completed if the project stops in between, then he can recognize revenue over a period of time. Otherwise, revenue only after handing over. So construction contracts and all, you cannot have a general principle. Each construction contract is different, project is different. Even for DLF itself, some projects, they may be over time, some could be at a point in time. We all know many cases, you have contracts like pay 10% now and pay 90% on handing over. So those cases and all, revenue will come only at a point in time when you hand over, not before that. Because in between, you will not have the right to enforce proportionate collection if the project stops in between. So each construction contract has to be evaluated carefully. So that's the only opinion which is there. And there are several issues in education material. There are about 62 issues which are there. I've captured it in the deck from here. Just to give you an idea, it talks about simple questions like difference between revenue and income, application real estate developers, and then it goes detailed on questions relating to identification of customer, non-monetary exchanges, the examples which I gave. All of these are in the form of the 62 questions available in this deck. I would allowed to go through that, but that's at least 2 hours of time only for those FAQs. But you can go through this. I'm sure in your office deliberations, you'll be able to connect in the context of the introduction I gave for the 5 principles, 5 steps rather. So thank you all for patient listening. My sincere thanks to past President Manoj Fadnis ji for the invite. It's sort of so kind of him to reach out to me and also accommodate today's date, because he actually wanted me to speak yesterday, but I could take it only today. It was so kind of him to accept my inconvenience and give me this opportunity. Thanks to Kemisha Ben for her continued good wishes and support in functioning and effective developments and consistent implementation of the standards, and the pride she brings to us with all her contributions at ISBA internationally in the context of Code of Ethics. And thank you all for your patient listening. Stay safe, stay healthy, stay accountable.
It's really being a pleasure to hear you, sir. And what a seamless presentation, I must tell you. Everyone is amazed to see that how a presentation and how in a time frame of 1.5 hours, how lucidly you have presented the whole standard. Amazing presentation as always. Now we had insight of both these standards today. First, as the tradition of our India, before income we should have tax. So Yognesh bhai, tell that, and then income is there with MP Vijaykumar sir. So thank you, sir, for having here. Now I request Atishay to kindly give a vote of thanks.
Thank you, sir. What a wonderful deliberation sir has given us on the most important topic of Ind-AS. I would say definitely that the sir, the way he has explained us, has just again reminded us that we are sitting in his class and coming out with the most crisp and clear ideas of the topic. We could clearly understand the 5-step model for revenue recognition with the wonderful examples that sir has given. Sir, we must say that you are definitely a Google on accounting aspects, wherein we just have to come to you and get all our concept clears. So on behalf of Indore branch and all the members present here, I would like to take this opportunity to thank you, sir, for not only sparing the time, but again allowing us to become a student of your class. Thank you, sir, and it has always been pleasure to listen you and will be pleasure for listen you more. So with this, we are concluding our Ind-AS marathon organized by Indore branch. And for this, we definitely would have to thank CA Manoj Fadnis sir, CA Kemisha ma'am, Aseem Trivedi sir, who has always been instrumental in raising the academic bars of the Indore branch with their resources. And special thanks to CA Kirti Joshi sir, chairman of Indore branch, CA Ankush Jain, for organizing a wonderful series of seminar on the most important topic of Ind-AS at the right time. From coming Friday, I would like to inform that from coming Friday, Indore branch is again coming up with another important series on standards on accounting for the members. And at last, I would like to thank all the learned members for their patient listening. Thank you, everyone.
Okay, Yognesh bhai, see you.
Bye, see you then.
Bye, Yognesh. Bye, Aseem.
Bye, namaskar, sir. Namaskar, VJ.